There was a time when Enron was not a cautionary tale, it was the future. At the dawn of the 2000s, this Houston company stood among the giants, the seventh largest in America, a $70 billion empire of energy, trading, and pure financial imagination. Then, in December 2001, reality disappeared almost overnight. Enron filed for what was then the largest bankruptcy in American history. Tens of billions of dollars in market value gone. A Wall Street darling that had promised endless growth and endless money suddenly revealed as a hollow shell. 1 month, it was worth more than many nations. The next, it was worth less than a rundown office building. This was the company Fortune magazine had crowned most innovative company in America 6 years in a row. Analysts praised its genius. Politicians courted its donations. Business schools held it up as a model of modern capitalism. Enron's leaders were described as visionaries who had transcended the boring world of pipelines and gas contracts and created a new kind of power, a trading machine that could turn volatility itself into wealth. But behind the glossy covers and breathless headlines, much of those profits were illusions. Enron used mark-to-market accounting to book the entire lifetime profit of a deal on day one, even when the cash would not arrive for years, if it arrived at all. Losses could be buried in off-balance sheet entities with friendly names and very unfriendly purposes. Debt could be hidden in partnerships run by its own chief financial officer. The story investors thought they were buying was not the life of a brilliant company, it was a script written in an accounting conference room. For employees, this was not an abstract fraud, it was family, future, and survival. Thousands had retirement accounts loaded with Enron stock, encouraged by a culture that treated loyalty as a financial strategy. While the share price soared toward $90, executives quietly cashed out hundreds of millions. When the truth finally surfaced and the stock plunged below $1, workers woke up to find that decades of savings had evaporated, even as the architects of the collapse had already walked away with life-changing fortunes. Enron did not just cook the books, it weaponized them. It weaponized accounting rules, corporate culture, and political influence to construct a reality so convincing that auditors, regulators, ratings agencies, and investors all saluted and signed on the dotted line. It is an example of what happens when intelligence is fused with ruthlessness and shielded by complexity, when a company learns to manufacture perception faster than anyone can check the numbers. So let me take you back to the beginning, long before the headlines and the handcuffs, when Enron was just a boring pipeline business dreaming of something bigger. This is the story of how that ordinary company rose to become Wall Street's golden child, how the machinery of fraud was built piece by piece, and how its spectacular unraveling reshaped corporate America and still casts a shadow over every earnings report today. On paper, Enron looked like the future. Not only was it one of the largest companies in America, it was praised as one of the most innovative, most admired, most destined for glory giants on Wall Street. In reality, it was a slow-motion crime scene hiding in plain sight, a place where the numbers were celebrated long after the truth had quietly left the building. Enron's story is not just a scandal. His story is one of what happens when innovation, ego, and greed are rewarded faster than reality can catch up. Executives weren't simply lying, they were reinventing the language of profit, turning accounting rules into weapons, and building an empire of paper wealth that dazzled analysts, politicians, and anyone who wanted to believe the miracle. It's an example of what happens when the scoreboard matters more than the game itself. There was a time when Enron looked like the purest symbol of American ingenuity. It wasn't just selling gas through old pipes. It was trading energy like stocks, betting on broadband capacity, and even creating markets in things as strange as weather derivatives. Magazines called it revolutionary, conferences treated its leaders like rock stars, and Wall Street lined up to pour in more money. The company talked about reshaping life itself, turning every flow of electrons or data into a tradable asset. But behind that glossy image, the same company was quietly turning itself into a financial crime scene. Deals that looked brilliant on day one were bleeding cash by day two. Mark-to-market accounting let Enron book decades of imaginary profit the moment a contract was signed, even if the project never made $1. Special purpose. Entities run by CFO Andy Fasto absorb billions in debt so the balance sheet could stay clean, while the real risks were shoved into dark corners. The duality was almost theatrical. Innovation on the front stage, accounting pyrotechnics, and ruthless pressure on the back. So the question hangs over the whole story. Was Enron a bizarre outlier, or just the loudest, flashiest expression of a broader Wall Street culture addicted to short-term numbers? Because the bonuses, the quarterly targets, the obsession with meeting the street were not unique. They were the air corporate. America breathed in the late 1990s, and Enron simply inhaled more deeply than anyone else. To understand how this happened, let me take you back to a very different world. There was a time when natural gas pipelines were dull, heavily regulated, and predictable, a utility-like business where fortunes were capped and risk was limited. Then came deregulation, financial engineering, and a new generation of executives who believed that with enough creativity, even the most boring asset could be turned into a high-speed money machine. From here, the journey will move fast. From the quiet pipeline days and the rise of Ken Lay, to Jeff Skilling's radical vision of an asset-light trading empire, to Andy Fasto's hidden partnerships and the technical tricks, mark-to-market, SPEs, off-balance sheet deals that held the illusion together. Then finally, the unraveling, the whistleblowers, the panicked phone calls, the trials, and the reforms that still shape how companies report their numbers today. Before the exotic finance, before the trading floors and the glowing stock charts, there was something far less glamorous: metal in the ground, long, cold, buried steel. Enron, the supposed wizard of the new economy, began life as a very old economy business. Let me take you back to 1985. Wall Street was gearing up for a decade of leveraged buyouts and corporate raiders, and in Houston, a former academic and banker named Kenneth Lay was engineering his own quiet revolution. He pushed through a merger between Houston Natural Gas and a Midwestern pipeline company called Internorth. On paper, it was a consolidation of two regional players. In reality, it created one of the largest natural gas pipeline networks in the United States and gave birth to a new name, Enron. There was a time when owning pipelines looked almost dull. The business was heavily regulated, with government agencies setting the rates companies could charge to move gas from point A to point B. The model was simple: charge fixed transportation fees, earn predictable returns, avoid surprises. It was steady, safe, almost utility-like. For families who depended on reliable heat in winter, it was comforting. For Wall Street analysts chasing high growth and eye-popping profits, it was the financial equivalent of watching paint dry. But outside those buried pipes, the rules were starting to change. Through the 1980s and early 1990s, Washington began deregulating natural gas. Price controls were lifted, pipeline access rules were rewritten, and buyers and sellers were slowly allowed to negotiate directly. A once sleepy, linear business, producer to pipeline to utility, was being broken apart into a competitive, market-driven arena where gas could be traded, swapped, and arbitraged. What had been a regulated toll road for molecules suddenly looked more like a highway system for money and power. Ken Lay saw this and refused to accept a future as a boring toll collector. His story is one of a man who wanted more than stable dividends and modest returns. He wanted an empire. He courted politicians and regulators, talked about free markets and innovation, and just as eagerly courted Wall Street. Enron, he promised, would not be another plodding pipeline outfit. It would be at the cutting edge of energy, technology, and finance, a company that turned gas flows and electrons into pure trading profits. Yet under the grand speeches and glossy annual reports, the reality remained stubborn. Enron still owned thousands of miles of heavy, capital-intensive pipes in the ground. The cash flows were regulated, the returns were capped, and the business looked far more like a utility than a Silicon Valley rocket ship. That tension between the slow, asset-heavy truth and the dream of a high-growth, high-multiple trading and technology company would drive almost every major decision that followed. It's an example of what happens when executives promise Wall Street a story their actual business cannot deliver. To keep the illusion alive, Enron would have to move further away from those pipes, deeper into abstract markets, and finally into something even less tangible than gas itself. The next step in that evolution would arrive with a new character, a new philosophy, and a far more dangerous idea. That more dangerous idea needed a salesman. Not a wild-eyed trader or swaggering dealmaker, but someone who looked like the safest man in the room. That man was Kenneth Lay. Let me take you back to a small Missouri town in the 1940s, where there was a time when the Lays were closer to poverty than power. Ken's father was a Baptist minister, paid little, moving the family from church to church, preaching about salvation and hard work. The boy absorbed two gospels at once, the Bible from the pulpit and the American dream from the culture around him. The belief that through discipline and free markets, a person could rise from nothing to real wealth. His story is one of quiet ambition wrapped in a friendly smile. Lay studied economics, earned a PhD, and slipped into the world of policy just as energy was becoming a battlefield. At the Federal Power Commission, he watched how government rules could make or break entire companies. Later, at the Department of the Interior and in regulated utilities, he learned the language of both sides, the bureaucrat's memo and the executive's earnings call. Each move built a network, first in Washington, then in Houston, a bridge between political power and corporate money. On paper, he looked like a technocrat. In person, he was something else. Soft-spoken, avuncular, with the cadence of a pastor and the optimism of a motivational speaker, Lay could reassure regulators, charm journalists, and make lawmakers feel like partners in a great national project. He talked about deregulation not as a windfall for traders, but as liberation for markets, consumers, and innovation. At times inspiring and at times chilling, his calm confidence made Enron seem less like a risky trading shop and more like a patriotic mission. As natural gas and electricity rules loosened, Lay moved fast. He positioned Enron as the poster child for deregulation, the company that would prove free markets work better than old monopolies. Campaign donations flowed to both parties, but especially to Republicans who preached the same faith in markets that he did. He played golf with presidents, hosted fundraisers, and made sure Enron's name was never far from key lawmakers' ears. Access wasn't an accident, it was an asset, engineered as carefully as any pipeline or trading platform. Yet beneath the sermons about growth and efficiency, another pattern formed. Lay genuinely believed in markets and in Enron's destiny as an empire of energy and information. But as long as the stock price climbed, uncomfortable questions could be delayed, delegated, or politely ignored. Trading profits that looked too smooth, accounting choices that seemed too aggressive, executives whose behavior felt a little too ruthless, these became background noise to a rising share chart and glowing magazine covers. It's an example of what happens when personal faith in an idea meets the seduction of Wall Street applause. The preacher's son wanted to prove deregulation could change the world. The next man in Enron's story wanted something sharper, not just belief, but domination. There was a time when the most dangerous man in American business didn't run factories or drill wells. He moved numbers. He believed markets could see everything, price everything, control everything. And at Enron, that belief was about to be given an empire to play with. Let me take you back to the late 1980s, when a young consultant from McKinsey & Company kept flying into Houston with a different way of looking at energy. His name was Jeffrey Skilling. Harvard Business School star, former banker, dazzling in interviews and terrifying in meetings, he was known for intellectual knife fights, where only the most aggressive ideas survived. Colleagues described him as obsessed with efficiency, with stripping out waste, with turning messy human reality into clean, tradable contracts. Enron, still mostly a sleepy pipeline company, hired McKinsey to figure out how to make money in a newly deregulated gas world. Skilling didn't just answer the question, he rewrote it. Why, he asked, should Enron be paid like a toll road, earning a regulated fee for shipping gas when it could be a gas bank instead? In his model, Enron wouldn't just move molecules, it would buy and sell long-term gas contracts, hedge risk for utilities, lock in prices for industrial customers, and skim profit from the spread, the way Wall Street skimmed profit from bonds. This was the first glimpse of his story. Skilling didn't see pipes and valves. He saw streams of cash that could be sliced, bundled, and traded. To him, markets were the ultimate information processor, ruthlessly efficient, brutally honest, always right in the long run. If something produced a cash flow, it could be turned into a product. Natural gas today, electricity tomorrow, then bandwidth, weather derivatives, even the risk that a factory might shut down in 5 years. Reality was messy. Markets could make it elegant. Because of that worldview, Skilling was magnetized by Enron's potential. Here was a company with physical assets, political connections, and a CEO eager for Wall Street applause. In 1990, he finally crossed the line from consultant to insider, joining Enron to build a new unit, Enron Finance Corp. His mission was simple and radical at the same time. Turn Enron from an asset-heavy pipeline operator into a light, fast, trading-driven machine. He began importing a new kind of talent into Houston. Not pipeline engineers in hard hats, but MBAs with color-coded spreadsheets, former Wall Street traders with high tolerance for risk, quants who spoke in probabilities and pricing curves. They were young, ambitious, fluent in the language of derivatives and discount rates, and they shared Skilling's faith that clever financial engineering could unlock hidden wealth trapped inside boring infrastructure. Inside Enron's offices, the culture shifted. The old guard, who knew every mile of pipe by memory, watched as 20-something analysts ran complex models that decided which contracts lived or died. Traders shouted across open floors, screens flashed with gas prices from Chicago to California, and bonuses were tied not to stable service, but to how much profit could be generated from volatility. At times inspiring and at times chilling, this new Enron looked like the future. Profit started to rise, Wall Street cheered, and Skilling's gas bank became the template for an expanding trading empire. Yet hidden inside the brilliance was a quiet problem. Once a company defines itself by growth, speed, and innovation, what happens when real-world profits slow down, but expectations keep rising? It's an example of what happens when a genius for financial innovation meets a market that never stops demanding more. The tools Skilling built would soon be pushed beyond honest limits, and the pressure to keep Enron's miracle alive would lead straight into the accounting shadows. Because for Jeff Skilling, if something could be imagined, modeled, and priced, it felt real enough to count. The next step was to make sure the numbers on Enron's books agreed. So when the numbers had to agree, Enron didn't just tweak the math. It rewired the entire human machine that produced those numbers. Culture became a weapon, and inside the glass towers of Houston, an old utility quietly died. There was a time when Enron looked like any other pipeline company. The halls were filled with engineers in hard hats, operators who knew every valve by touch, clerks who had spent 20 years tracking gas flows with the care of a family budget. Their pride came from reliability, from keeping the lights on in small towns and big cities, from a life measured in safe deliveries rather than explosive growth. Then Skilling's vision arrived, and with it, a new breed. Young MBAs from Harvard and Wharton, traders from Wall Street, 20-somethings who talked about options pricing instead of pipe diameter. They flooded into Enron's trading floors, screens glowing, phones ringing, money moving. The old pipeline empire was being refitted into a high-velocity financial machine, and the message was clear: adapt to the new game, or get out of the way. To accelerate that transformation, Enron embraced something employees would learn to fear: rank and yank. Every year, everyone was graded on a forced curve. The stars at the top were showered with promotions, bonuses, and praise. The bottom 15 to 20% fired. No appeal, no safety net, just a quiet meeting with HR and a cardboard box. Because of this ruthless system, colleagues stopped being teammates and became competitors, hoarding information, undermining rivals, and watching the rankings like a stock ticker. In that environment, risk wasn't just accepted, it was celebrated. Close a flashy deal that made next quarter's earnings pop, and the rewards were immediate. Bigger bonus, bigger title, bigger office. Question whether the deal would ever produce real cash, and suddenly the room got cold. It's an example of what happens when short-term numbers are treated as reality, and long-term consequences are treated as someone else's problem. Enron turned this into a cult of intellect. Employees were told and soon believed that they were the smartest people in the room, above the boring rules that governed traditional utilities. Complex models, exotic contracts, off-balance sheet entities, these weren't red flags, they were badges of genius. At times inspiring, and at times chilling, the belief was that sheer brainpower could bend markets, regulators, even physics, as long as the spreadsheet said the trade worked. Inside that cult, morality began to erode almost unnoticed. There was no open order to lie, just a steady signal that skepticism was weakness, and loyalty meant defending the illusion. Analysts who asked hard questions were mocked. Internal critics were labeled not a team player. Careers were made not by telling the truth, but by seeing how far the numbers could be pushed without breaking. Let me take you back to those trading floors one more time, because behind the glowing screens and soaring profits, a quieter calculation had already begun. How much reality could be buried before it finally exploded into view? On those early trading floors, before Enron became a global punchline, the numbers were not yet fiction. They were dangerous for a different reason. They were real, and they were spectacular. There was a time when Enron's traders were not magicians, but merchants building a new kind of marketplace out of phone calls, spreadsheets, and long-term gas contracts. Let me take you back to the early 1990s. Natural gas had just been deregulated. Pipelines were no longer forced to act like quiet toll roads, and Skilling saw an opening. Enron would sit in the middle of buyers and sellers, locking in long-term contracts to move gas years into the future. If Enron could buy 10-year supply at one price, sell 10-year delivery at a higher price, and manage the risk in between, the difference was pure money. Not from drilling wells, but from knowing where prices were headed before everyone else. The company turned its pipeline network into a weapon. Because Enron owned huge stretches of pipe, it knew where capacity was tight, where winter might pinch, where a new power plant would quietly change demand. Traders could see that a utility in the Midwest was desperate for secure supply, while a producer in Texas was desperate for a guaranteed buyer, and Enron would step between them, write both contracts, and keep the spread. It was textbook arbitrage, just done at a scale the old pipeline men could barely understand. Early on, the bets worked. Gas prices swung, and Enron was on the right side. A cold winter here, a demand spike there, and the trading desk printed profits that made the old regulated returns look like pocket change. In 1990, Enron's trading profits were modest. A few years later, they were driving the story on every earnings call. Wall Street, always hungry for a new empire of growth, noticed. Analysts who once saw Enron as a boring pipeline utility now praised it as a high-tech energy bank. The stock was rewarded with a premium valuation, trading well above its plodding peers. Reports gushed about innovation, about asset-light earnings, about a company that had escaped the gravity of physical pipes and steel. Because of those early legitimate wins, Skilling and Lay were treated as visionaries, as if they had discovered a cheat code for turning volatility into endless wealth. His story is one of escalation. If trading gas worked this well, why not electricity with its wild price swings? Why not coal, broadband capacity, even weather? It's an example of what happens when real success convinces leaders that the curve must always bend up. Once the market began expecting double-digit growth, forever, every quarter, without fail, the pressure hardened. The line between aggressive accounting and outright fraud did not move overnight. It was nudged, quarter by quarter, contract by contract, until the same trading machine that had once generated honest profits became the perfect cover for numbers no longer anchored to reality at all. That quiet shift in the line between aggressive and fraudulent set the stage for Enron's favorite magic trick, a way to turn hopes about the future into hard profit today. To Wall Street, it looked like genius. Inside the company, it was given a more technical name, mark-to-market accounting. There was a time when a utility company built a power plant, signed a long-term contract, and then recorded revenue slowly, year after year, as the electricity was actually delivered. Boring, predictable, grounded in cash. Enron asked a different question. Why wait? With mark-to-market, the day a deal was signed, Enron would estimate all the money that contract might make over 10 or 20 years, run it through its own models, and then book that entire projected profit immediately, as if it already existed. Imagine a 20-year energy contract to supply power to a city. The real cash will dribble in over 2 decades through recessions, elections, price swings, and regulatory fights. But on day one, Enron's traders plug optimistic assumptions into complex spreadsheets, decide this deal will generate, say, $2 $2 billion in profit over its life, and then record that $2 billion as income right now. No waiting, no uncertainty on the income statement. The empire grows with a keystroke. This was not some quiet back-office experiment. Jeff Skilling pushed for it relentlessly. He argued to the SEC that Enron's new energy trading business looked more like a Wall Street derivatives desk than a traditional pipeline utility, so it deserved Wall Street-style accounting. After debate, the regulators agreed. Mark-to-market, once reserved for certain financial instruments, was now officially blessed for Enron's sprawling energy contracts, a decision that would pour gasoline on the company's rise. On paper, it was elegant. In practice, it was an invitation. Because the profit depended on Enron's own projections, executives could move earnings by tweaking discount rates, future gas prices, customer demand curves, and risk premiums. Change a few inputs and a modest contract suddenly became a jackpot. The cash in the bank barely moved, but reported wealth exploded. It's an example of what happens when numbers driven by ambition are treated as if they were facts. Here, the moral tension sharpens. Mark-to-market can be legitimate. Used carefully, it can give investors a faster, more realistic picture of trading positions that change by the minute. But at Enron, in a culture worshiping growth and stock price, it became the gateway drug. Wishful thinking turned into official earnings. Forecasts hardened into guaranteed profit, and anyone who questioned the models threatened the flow of money, bonuses, and power. Then came the pattern no one outside could see yet. Once a company learns it can manufacture profit with assumptions, what happens when reality fails to cooperate? The answer would push Enron even further into the shadows, toward structures designed not just to create income, but to bury mounting losses where almost no one could find them. There was a time when every quarter at Enron felt like exam day in a school where the only passing grade was perfection. As earnings season approached, the trading floors and deal rooms went electric. Phones lit up, negotiations dragged late into the night, and people who had barely spoken all month were suddenly best friends if it meant closing one more deal before the conference call. Because bonuses, promotions, even basic survival depended on those numbers, the pressure was relentless. Hit the target and life changed. Bigger checks, more stock, a seat closer to the inner circle of money and power. Miss it and careers stalled, reputations dimmed, and the empire everyone had been promised started to look fragile. So deals were not just signed for economic value, they were sculpted for appearance, carved to look beautiful on paper the moment ink hit the page. Under mark-to-market, a 20-year energy contract could be transformed overnight into a huge profit on day one. The cash might not arrive for decades if it arrived at all, but the spreadsheet said Enron had already won. So traders learned to front-load the upside and push the real risks and costs far into the future, where another quarter, another team, another unlucky soul would deal with them. Let me take you back to those internal valuation meetings. A handful of senior dealmakers would crowd around complex models, vast spreadsheets with color-coded tabs, and formulas buried 3 layers deep. Only a few people truly understood them, which meant only a few people controlled the assumptions that decided whether a deal was a triumph or disaster. Change a discount rate here, a projected price curve there, and a mediocre trade suddenly became a career-making victory. Unrealistic forward price curves became a quiet habit. Future gas prices were drawn as smooth, rising lines, as if markets had sworn never to crash again. Counterparty risk, the chance that the other side might never pay, was politely minimized or ignored. Costs that would have made the quarter look ugly were reclassified, shifted, or delayed to keep reported earnings smooth and ever rising. It was at times inspiring and at times chilling, a story of human ingenuity used not to understand reality, but to bend it. On the surface, it worked. Wall Street cheered, magazines praised Enron as the most innovative company in America, and employees watched their paper wealth explode. Yet inside the models, something stubborn refused to move. Even with aggressive curves, even with ruthless optimism, the real cash lagged behind the reported profit. That growing gap became the quiet secret of Enron's life. The numbers looked flawless, the bank accounts did not. And when even the most creative assumptions could no longer close that distance, leadership finally crossed a darker line, searching for structures that would not just polish earnings, but bury the truth where almost no one was meant to look. That hidden place had an architect. His name was Andrew Fastow, and inside Enron's empire of numbers, he would become both its chief engineer and eventually its demolition crew. There was a time when Wall Street analysts spoke his name with admiration, not suspicion. To them, he was the quiet genius behind the curtain, the man who could turn risk into profit and debt into something that, on paper, almost disappeared. Let me take you back to his life before Enron's glory years. Fastow wasn't a cowboy trader or a swaggering salesman. He was a finance professional, trained in the language of balance sheets and cash flows, with a specialty in structured finance. After business school and a stint in banking, he understood the new Wall Street, complex securities, off-balance sheet vehicles, and the art of slicing risk into ever finer pieces. To someone like Jeff Skilling, obsessed with growth and desperate for money to keep flowing, this was exactly the kind of mind he wanted at his side. Fastow joined Enron in the early 1990s, just as the company was transforming from a boring pipeline operator into a high-flying trading powerhouse. His story is one of rapid ascent. He moved from managing finance for Enron's growing trading operations to overseeing elaborate funding deals across the company. Each time a problem appeared, a risky asset, a volatile investment, a lender getting nervous, Fastow would arrive with a new structure, a new vehicle, a new way to manage the risk without slowing the growth story. By 1998, he had been rewarded with the title of Chief Financial Officer. Ken Lay trusted his calm explanations. Skilling trusted his ability to find a way to keep the rating agencies happy and the stock price rising. Because of his complex deals and seemingly magical solutions, Fastow became the internal fixer, the man executives turned to when reality refused to cooperate with the narrative they were selling to the market. In Fastow's mind, capital markets were a puzzle. If a straightforward loan made Enron's debt look too high, he would search for a structure that moved that loan somewhere else. If an asset was bleeding money, he would hunt for a way to package it, finance it, and push the risk off Enron's books. The line between genuine risk management and quiet deception did not vanish overnight. It was nudged, bent, then finally crossed. The key tools were special purpose entities, or SPEs. On the surface, they were separate companies, created to finance assets, share risk, and give Enron flexibility. In practice, many of Fastow's SPEs became financial black holes, sucking in Enron's worst losses and heaviest debts so that the main balance sheet stayed glossy. It's an example of what happens when technical brilliance is paired with a culture that rewards appearances over truth. At times inspiring and at times chilling, Fastow's creativity didn't just protect Enron, it enriched him personally, as he arranged to manage some of these entities himself. That quiet conflict of interest would remain hidden while the stock soared. But as the market finally began to demand real transparency, the very structures that once shielded Enron from scrutiny would become the threads investigators would pull, unraveling the entire empire in their hands. Those threads led straight into one of the strangest inventions of late 90s finance, the special purpose entity. On paper, it sounded harmless. In reality, it became the magic trick behind the curtain that let Enron look rich, clean, and unstoppable while the rot spread through its empire. There was a time when a special purpose entity, or SPE, was a boring tool. A company might create a legally separate partnership for one project, one pool of assets, one slice of risk. If a bank wanted to finance a power plant without gambling its whole life on that one bet, it could tuck the plant into an SPE. The idea was simple: isolate danger, keep the main house safe, and let investors choose exactly which risk they wanted to buy. Accounting rules of the era turned that idea into a loophole large enough to drive Enron's balance sheet through. If outside investors contributed a small sliver of real equity, usually around 3%, and if they were deemed to control the entity, then the parent company did not have to put that SPE's debt on its own books. The obligations existed in the shadows. The parent could show the upside, avoid the downside, and still claim that everything was technically within the rules. Enron seized on this with ruthless creativity. Let me take you back to the late 1990s, when Wall Street worshipped asset-light companies with smooth earnings and soaring stock. Enron created not a handful, but hundreds of SPEs. Some were used to buy underperforming assets Enron no longer wanted to admit were failing. Others borrowed billions, assumed Enron's debt, and quietly carried it away from the main financial statements. On the surface, Enron's leverage looked modest. Underneath, it was drowning. The company went further. Certain SPEs were structured to hedge Enron's own stock and investments. Losses on risky bets could be offset by gains booked inside these entities, even when the gains were tied to the same volatile Enron shares. It was like using a mirror to ensure another mirror. The reflections looked impressive. The underlying wealth was fragile. Picture a family home that has become a disaster. Broken furniture, unpaid bills, mold creeping up the walls. Instead of cleaning, the owner rents a storage unit down the street. All the mess gets hauled out, locked away, and legally the unit is in someone else's name. Then the owner invites buyers over, throws open the front door, and proudly announces, "Look how spotless this house is." That was Enron's relationship with its SPEs. But here comes the twist. Many of these entities were not truly independent at all. Andrew Fastow, the CFO tasked with protecting Enron's financial health, would soon be running some of the very partnerships doing business with Enron. His story is one of at times inspiring and at times chilling ambition, designing complex structures, earning huge fees, and signing deals with himself. It's an example of what happens when money, power, and weak oversight collide. On paper, the rules were met. In practice, the guardrails were gone. The next revelation would show just how far Fastow and Enron were willing to push this private empire of off-balance sheet ghosts. Fastow's private empire was now humming in the shadows, but the next move would take the conflict of interest from alarming to surreal. There was a time when a chief financial officer was expected to guard a company's money. At Enron, the CFO was about to become the company's counterparty, its supposed savior, and its silent executioner, all at once. Let me take you back to 1999. Fastow sets up two partnerships, LJM1 and LJM2, named after his own family, wife Leah, and sons Jeffrey and Matthew. The branding is almost tender, the purpose is anything but. On paper, LJM will buy Enron's ugliest assets, provide hedges for Enron's risky investments, and transfer risk off the balance sheet. In reality, Fastow now controls private pools of money that live off deals with the company he runs financially every single day. Here is the conflict in its purest form. As Enron's CFO, he structures the transactions, blesses the valuations, and signs off on the disclosures. As LJM's manager, he negotiates against Enron, pushes for better terms for his investors, and takes rich fees for himself. He is both the referee and the player, writing the rules and keeping the score. His story is one of turning a corporate finance job into a private toll booth on a public company's cash flows. LJM is just the beginning. To handle the growing pile of volatile tech and energy investments that might suddenly plunge in value, Enron creates a new family of entities with a more aggressive name, the Raptors. These are special purpose entities funded largely with Enron stock options, and complex derivatives. Their mission is simple. If Enron's investments lose money, the Raptors take the hit, letting Enron keep reporting smooth, rising earnings. On the surface, it sounds clever. Underneath, it is a hall of mirrors. The hedges that are supposed to protect Enron are ultimately backed by Enron's own inflated shares. Losses on risky ventures are offset by gains on Enron stock held inside the Raptors. Gains that only exist as long as the market believes the very earnings those Raptors are helping to fake. It's an example of what happens when financial engineering stops managing risk and starts manufacturing an illusion of wealth. The circularity is brutal. Enron uses its soaring stock to guarantee the Raptors. The Raptors use that guarantee to pretend away losses. Those fake earnings help keep Enron's stock soaring. As long as the price climbs, everyone looks brilliant, the bonuses flow, and the auditors nod along. The system feeds on confidence, leverage, and a rising share chart. But what happens when gravity returns? When the tech bubble cools, when Enron's investments stumble, and the Raptors need real value instead of paper promises, every hedge line on the spreadsheet points back to the same source, Enron itself. The moment the stock slips, the protection unravels, the losses rush home, and the next section will show how quickly that beautiful, ruthless machine turns on the people who trusted it. The moment the stock slips, the protection unravels, the losses rush home, and on Wall Street, that danger has a price ticker. There was a time when Enron's ticker was the brightest light on the screen, a rising star that seemed immune to gravity, risk, or even basic math. Through the late 1990s, Enron's stock didn't just climb, it rocketed. From a sleepy pipeline company to a market darling valued at over $70 billion, it vaulted into the ranks of the 7th largest company in the United States. Not only was it hailed as the most innovative company in America, it was held up as the future of energy, of trading, of the modern corporate empire itself. Every quarter brought another record, another headline, another reason to believe that this was the place where wealth was being manufactured on command. Wall Street analysts lined up to agree. Major firms slapped strong buy ratings on Enron with almost religious enthusiasm. Reports praised its visionary leadership, its revolutionary business model, its limitless growth prospects. Behind closed doors, many of those same analysts admitted they didn't fully understand how Enron actually made its money, but the stock kept going up. The conference calls sounded confident, and no one wanted to be the one person on the street who didn't get the joke. It's an example of what happens when reputation replaces due diligence. Inside the company, that soaring share price wasn't just a scoreboard, it was the oxygen of executive life. Ken Lay, Jeff Skilling, Andrew Fastow, and their inner circle were paid not merely in salaries and bonuses, but in mountains of stock options. The higher the stock went, the more their personal fortunes exploded. On paper, they were becoming fantastically rich, watching 8-figure, even 9-figure possibilities appear with every uptick. The message was clear: protect the price at all costs. Questioning the numbers meant threatening the money. So expectations had to be managed like a stage show. Earnings calls were carefully choreographed performances where bad news was buried in jargon and good news was amplified with confident forecasts and intricate charts. Favored analysts received selective disclosure, private meetings, and reassuring explanations that never quite made it into the public transcripts. Skeptics who asked uncomfortable questions were brushed off, mocked, or frozen out of access. At times inspiring and at times chilling, the performance worked, right up until it didn't. Meanwhile, the people with the least power had the most to lose. Thousands of employees watched their retirement plans swell with Enron stock, encouraged by leadership, by company culture, by the intoxicating belief that they were building something unstoppable. Many had pensions heavily concentrated in a single name, their employer. When the price went up, their future looked secure, even generous. But the higher that price climbed, the more catastrophic the fall would be. The next part of this story shows what happens when that illusion finally shatters, and the empire built on confidence turns on its own family. Inside Enron, that soaring stock price wasn't just a number on a screen. It was a scoreboard, a ranking system, a weapon. The entire life of the company was wired to one idea: hit the target today, and tomorrow will take care of itself. There was a time when a single deal could change an employee's year. Close a massive energy contract, sign a broadband swap, move a complex derivative no one fully understood, and a banker or trader might walk away with a 6 or 7 figure bonus. Not when the cash actually arrived, on day one. Because of mark-to-market accounting, projected profits were treated as real money instantly. If a model said a contract would earn $100 million over 10 years, Enron booked it now, executives collected now, and the risk that it might never materialize was quietly buried. This created an empire of deals for deal's sake. People chased transactions that looked impressive on paper, pushed the limits of what could be justified, then pushed further. A project that would lose money in real life could still make a career, as long as the spreadsheet glowed green this quarter. Bonuses were tied to reported earnings, not long-term performance, so the pressure ran one way, up and to the right. Miss the number, lose the bonus. Hit the number, get promoted. Question the number, lose the room. Because dissent had a price. Employees who probed too deeply into the economics of a deal, who asked why debt kept disappearing into special purpose entities run by the CFO, found doors quietly closing. Careers stalled. Promotions evaporated. Some were reassigned to corporate Siberia, far from the trading floors and executive suites where the real power lived. Others were told in more or less polite language that maybe Enron just wasn't the right fit for them. Complexity became the perfect shield. Let me take you back to those internal meetings where a few people controlled the narrative with dense slides, obscure jargon, and a confident smile. If someone admitted they didn't understand the structure, the answer was simple: you're not smart enough yet. At Enron, confusion wasn't a warning sign, it was a social embarrassment. No one wanted to look slow in a room that called itself the smartest guys in the room. That slogan wasn't a joke, it was a world view. His story is one of men who believed their own brilliance put them above ordinary rules, above conventional accounting, even above the basic math of profit and loss. It's an example of what happens when arrogance, money, and unchecked power feed on each other inside a single company. At times inspiring and at times chilling, the internal bravado turned ethical lines into mere suggestions. Then came the pattern interrupt inside the machine. A few insiders who stopped laughing at the slogans, who stopped nodding along. While most still chased bonuses and guarded their silence, a small number finally decided that not understanding was no longer acceptable and that pretending might be fatal. Their choice to speak would collide head-on with this culture in the next chapter of the story. Those insiders were about to discover that confusion was not a bug in Enron's system. It was the business model, because inside this empire, the goal was no longer just to trade energy. The goal was to trade everything. There was a time when Enron was simply a pipeline company, moving natural gas from point A to point B for a regulated fee. That was too small, too boring, too grounded in reality. Under Jeff Skilling, Enron reinvented itself as a pure trading powerhouse, first in natural gas, then in electricity, inserting itself as the middleman in power markets across the United States and into Europe. Power plants, utilities, even small municipalities suddenly found themselves dealing with Enron traders who promised liquidity, price stability, and of course, higher profits. Let me take you back to the late 1990s when electricity deregulation was spreading and chaos was an opportunity. Enron's traders did not just buy and sell power. They designed complex contracts, long-term supply deals, and exotic options that few customers fully understood. Every new market opened meant more volume, more volatility, more chances to skim money from the spread. On paper, it looked like the future of energy. In practice, it looked like a casino where the house wrote its own rules. But energy alone could not satisfy the ambition. Enron wanted to be the marketplace for everything that could be measured: gas, power, bandwidth, even the weather. Enron Online, launched in 1999, was rolled out as a revolutionary electronic trading platform, a one-stop shop where hundreds of products could be bought and sold with a click. Executives bragged that it would be the Amazon of commodities, the eBay of electrons, the nervous system of global markets. Wall Street loved the story because it sounded like Silicon Valley with pipelines. Then the products became stranger. Enron pushed weather derivatives, contracts that paid off if temperatures or rainfall deviated from historical norms. It launched broadband trading, promising to buy and sell internet bandwidth as easily as natural gas. There were contracts on dark fiber, on future capacity that barely existed, on elaborate structures that made sense only in PowerPoint. To investors, each venture was sold as the next growth engine, the next billion-dollar platform, the next chapter in a life of limitless wealth and power. Here is where the illusion deepened. Using mark-to-market accounting, Enron booked the projected profits from these long-term, experimental deals on day one. Optimistic spreadsheets were treated as cash in the bank. A 20-year bandwidth contract that might never be used became instant earnings. A weather hedge with almost no real demand became proof of innovation. The more outlandish the market, the easier it was to hide how little real money was coming in. It's an example of what happens when hype outruns reality and accounting is used as a weapon. Behind the glossy presentations, many of these businesses were hemorrhaging cash. The trading screens looked busy. The narrative sounded at times inspiring and at times chilling, but the losses were piling up in the shadows. To keep the empire standing, Enron would now go to extraordinary lengths to bury those losses where no one was supposed to look, until someone did. To see how far Enron was willing to go, let me take you back to California at the end of the 1990s. Not to a boardroom, but to a place where the lights were about to start going out in real homes, on real streets, while a handful of traders watched the chaos from glowing screens and laughed. There was a time when California decided to trust the market. Lawmakers deregulated parts of the electricity system, splitting it into a complex maze. Utilities had to buy power on wholesale markets, retail prices were capped, and new trading platforms promised efficiency and lower costs. On paper, it sounded modern, scientific, almost inevitable. In practice, it created the perfect playground for anyone ruthless enough to weaponize that complexity. Enron's answer was its West Coast trading desk, a buzzing floor of phones, monitors, and 20-something hotshots who saw electricity not as a public necessity, but as a video game with real money attached. They gave their schemes code names that sounded like bad action movies: Death Star, Fat Boy, Ricochet. Each one was a different way to twist the rules, to turn the state's fragile system into a private casino for the empire in Houston. Under Death Star, Enron traders pretended to relieve congestion on California's power lines. They scheduled electricity to flow one way, then quietly reversed it or never moved it at all, collecting fees for solving a problem they had manufactured on paper. With Fat Boy, they overscheduled demand, claiming utilities needed more power than they actually did, then sold back the phantom surplus at a premium. Ricochet was even simpler. Buy power in California at capped prices, export it out of state, then re-import it as out-of-state electricity at uncapped, sky-high rates. The result was artificial shortages, rolling blackouts, and a market that looked tight, not because California ran out of power, but because traders had learned how to lock it in a financial cage. Families sat in the dark, traffic lights died at intersections, small businesses lost food, customers, and income, while wholesale prices exploded by hundreds of %. Because utilities couldn't raise retail rates fast enough, they bled money and in some cases collapsed, even as Enron's revenue numbers soared. On recorded tapes, Enron traders can be heard joking about the crisis, mocking Grandma Millie paying more for electricity, laughing about taking money from those poor grandmothers in California. It's an example of what happens when numbers on a spreadsheet become more real to a company than the lives behind those bills. The story stops being about clever accounting and starts being about children doing homework by candlelight, so a trader's bonus pool looks a little fatter. This is the moral pattern interrupt in Enron's life as a business legend. The fraud was never just abstract finance. It translated into poverty for some, sudden wealth for others, and political shockwaves that reached all the way to the governor's office. And yet, even as California burned through cash and patience, Enron was only getting more confident, more celebrated, and more dangerous, until the first serious cracks finally began to show. Enron was now a star, but behind the glowing headline, something subtle and dangerous was happening. There was a time when this company actually owned hard assets, moved real gas through real pipes, and made money the slow, boring way. That era was ending. A new Enron was being born, not an operating business, but a deal machine. Let me take you back to the late 1990s, when Jeff Skilling's vision of a pure asset-light trading empire finally took hold. Power plants, pipelines, broadband networks, these were no longer seen as businesses to run for decades, but as inventory to flip. Bankers and executives crowded into conference rooms, drawing up asset sales, structured financings, and swaps that existed less to move energy and more to move numbers on the income statement. The goal was simple: create a deal, book a gain, show growth, repeat. On paper, it looked brilliant. Enron would sell a troubled asset to a special purpose entity, often one that its own CFO, Andrew Fastow, quietly controlled. The company booked an immediate profit on the sale, celebrated the jump in earnings, and told Wall Street it had freed up capital. But buried in the term sheets were guarantees, total return swaps, and side letters that left Enron still holding the real risk. If the asset fell in value, the losses would boomerang right back to Houston. This was accounting alchemy. Gains were real enough for the quarterly report, but the danger stayed in the family? Because of these ruthless financial tricks and circular guarantees, Enron could claim record earnings while its actual cash flow from operations lagged further and further behind. The cash coming in the door told one story. The glossy earnings release told another. Analysts noticed the gap, muttered about working capital swings, and then raised their price targets anyway. Inside the company, not everyone was fooled. Some mid-level finance staff started running quiet comparisons, lining up reported profits against the meager cash the businesses were generating. The pattern was undeniable. Enron was eating its seed corn, selling pieces of its future just to keep the growth story alive today. Yet speaking up meant career damage, ridicule, or exile to some forgotten corner of the empire. Many chose silence, telling themselves the geniuses upstairs must know what they were doing. It's an example of what happens when the pressure for infinite growth crushes basic financial reality, at times inspiring and at times chilling in how long it can go on. Quarter after quarter, Enron appeared unstoppable, a monument to innovation and wealth. But outside the echo chamber, a few people were starting to ask uncomfortable questions. One skeptical analyst, buried in spreadsheets and footnotes, was about to notice a simple inconsistency and ask Enron a question it had no good answer for. That simple inconsistency turned into a simple question, and in a world built on $70 billion of market value and Wall Street hype, a simple question could be dangerous. There was a time when analysts treated Enron's quarterly calls like a masterclass in modern finance. The company's life looked flawless on the surface: soaring revenues, new markets, endless talk of innovation and wealth. But buried in those glossy presentations were financial statements that ran to hundreds of pages, with dense footnotes, vague segment descriptions, and almost no clarity on which businesses actually made money. Enron reported trading volumes, value at risk, and exotic metrics. What it did not report in any straightforward way was, here is where the profit really comes from. So one analyst finally said the quiet part out loud. Let me take you back to an Enron conference call in early 2001. The line is full of bankers, fund managers, reporters. The company has just finished another victory lap, talking about broadband dreams and global energy trading. Then an analyst, skeptical and tired of the fog, asks the question that cuts through all the jargon. Can you explain how you make your money? Not how you move gas, not how you structure contracts, how you actually earn profit. On the other end of the line, Jeff Skilling snaps. His voice tightens, the charm drops. Instead of a calm explanation, he lashes out, calling the analyst an expletive, dismissing the question as naive, implying that anyone who had to ask simply did not understand the genius of the empire he was building. It was a tiny crack in the polished image, but it revealed something important. Real power explains itself. Fragile power gets angry. Because of that fragility, Enron developed a playbook for dealing with critics. Analysts who pushed too hard were told they didn't get it. Management hinted that access could disappear, that meetings would dry up, that their firms might miss out on future deals. Behind the scenes, executives called their bosses, questioned their competence, and quietly suggested that maybe someone more enthusiastic should be covering this miraculous company. In a Wall Street culture obsessed with fees, rankings, and relationships, that kind of pressure was often enough. Meanwhile, the financial disclosures themselves became a weapon. It's an example of what happens when complexity is used not to enlighten investors, but to exhaust them. Hundreds of special entities scattered through the notes, vague references to related party transactions, layers of jargon around risk management and trading strategies. Anyone trying to map the true flow of money hit a maze of abbreviations and cross-references. The message was subtle but clear. If you cannot follow this, the problem is you, not us. Yet behind the bravado, something else was happening. Inside Enron, a few insiders were running their own numbers, staring at the same footnotes and feeling a chill. The profits were too smooth, the debt too well hidden, the promises too big for the cash coming in. They began to wonder how long a house of cards built on intimidation and opacity could really stand. And soon, one of them would decide that staying silent was more dangerous than speaking up. Those insiders staring at the footnotes weren't the only ones who should have felt a chill. There was a time when another set of eyes was supposed to catch the danger long before the public ever saw it, the auditors. And not just any firm, but Arthur Andersen. For most of the 20th century, Andersen was accounting royalty. Not only was it one of the big five firms, its name was a kind of financial halo, a promise that the numbers had been tested, challenged, and scrubbed clean. Banks, pension funds, entire families trusted that halo. If Andersen signed off, the story went, the books were solid, the empire was real, the wealth was earned, not imagined. But by the late 1990s, that old reputation for rigor was colliding with a new hunger for money and power. Andersen didn't just audit Enron, it sold Enron consulting projects, internal audit services, and elaborate advice on how to structure deals, earning tens of millions of dollars a year. The watchdog wasn't just guarding the house, it was decorating the living room, installing the locks, and sending a monthly bill. When a single client becomes that lucrative, how independent does independent auditor stay? Let me take you back to the way the relationship actually worked. Andersen partners weren't distant referees parachuting in once a year. They were embedded on site with offices inside Enron's headquarters, socializing with executives, absorbing the same aggressive culture. At times inspiring and at times chilling, Enron's story of innovation, risk, and relentless growth became their story too. In some cases, Andersen personnel helped design special purpose entities and complex financings that they would later be asked to audit. They were grading their own homework, and the curve was generous. That's how wildly optimistic mark-to-market numbers sailed through. Enron would sign a 20-year contract and immediately book the entire projected profit on day one, using assumptions that made reality look timid. Andersen accepted those forecasts, even when internal reviewers warned they were too rosy. The firm allowed dubious off-balance sheet treatment for Andrew Fasto's SPEs, letting billions in debt vanish from Enron's main financial statements. When technical staff inside Andersen questioned the structures, partners overruled them, worried about client relations and fee streams rather than whether investors were being misled. Here's the pattern interrupt. On paper, the audit opinion looked dry, routine, even boring. In life, it was the permission slip that let Enron keep raising money, selling stock, and telling the world that everything was fine. It's an example of what happens when gatekeepers chase fees and friendships instead of the truth. The check on management disappears, the lines blur, and the very people meant to protect the public become part of the sales team. And once the watchdog joins the pack, the next question becomes brutal. Who, if anyone, is left to blow the whistle when the numbers stop adding up? At Enron, that question didn't stay hypothetical for long. There was a time when the only people who really understood the maze of deals were the ones being paid to say everything was fine. Then a quiet accountant from inside the empire started asking the wrong questions. Her name was Sharon Watkins. Mid-level vice president, Texas accent, no celebrity title, but years of hard accounting work behind her. She had grown up in a world where numbers had to tie out, where debits met credits, and where you did not hide debt in the shadows just to keep the stock price up. Inside Enron, she watched Andrew Fasto's creations multiply. The Raptor structures, the web of special purpose entities that moved losses off the balance sheet while Fasto personally made money from the other side of the table. Let me take you back to the summer of 2001. Enron's stock had already started to sag. The market was getting nervous, and behind the scenes, Watkins was tracing the Raptors like a forensic pathologist. What she found was not innovation, it was a time bomb. The company was propping up its own deals with its own inflated stock, using SPEs to hide billions in risk, and praying the market would never call the bluff. If the stock kept falling, the protections would fail, and the whole arrangement could collapse in on itself. So in August 2001, she did something almost no one in that culture of fear and bonuses dared to do. She wrote a memo directly to Ken Lay, the chairman, warning that Enron might implode in a wave of accounting scandals. Not might have a rough quarter. Implode. She laid out concrete concerns. The Raptors, the conflicts of interest around Fasto, the off-balance sheet debt, the way these entities threatened Enron's very life if auditors or regulators ever forced a reckoning. Lay's response sounded responsible on the surface. He brought in Enron's law firm, Vinson and Elkins, and asked Arthur Andersen for another look. Internal review, external review, meetings, memos, conference calls. On paper, it looked like action. In reality, it was an example of what happens when damage control is valued more than truth. The scope was tightly controlled, the instructions were narrow, and no one was told to dig so deep that the empire might actually shake. Watkins found herself in a strange no-man's land. She wasn't fired, dragged out, or immediately turned into a hero. She was moved, managed, kept close enough to monitor, yet far enough from real power. Inside the company, she became a kind of uneasy conscience, a reminder that someone had put the danger in writing while everyone else rossed to protect their money, their careers, their fragile wealth. His story is one of ruthless ambition, but in this chapter, the spotlight shifts. While Ken Lay quietly weighs how much truth the market can handle without panic, another shock is brewing inside Enron's leadership. This time, it won't come from a memo. It will come from one of the stars of the executive ranks finally walking away. There was a time when Jeff Skilling looked untouchable. The architect of Enron's transformation, the prophet of the asset-light empire, the man Wall Street adored because he seemed to turn volatility into money on command. And then, in August 2001, after just 6 months wearing the crown as CEO, he walked into a boardroom and said he was done. Officially, it was for personal reasons. The announcement hit the wires on a quiet summer day, and for a moment, the market froze. This was the visionary who had sold analysts on Enron as the most innovative company in America, the man who had mocked doubters on earnings calls and promised a future of endless growth. You do not build a $70 billion mirage and then casually resign because you want more time with the family. Inside Enron's glass towers in Houston, the reaction was immediate and electric. Trading floors went silent, then loud, then oddly polite. Some employees joked dryly that the king of mark-to-market had finally marked himself to reality. Others whispered in hallways, refreshing their stock price screens every few minutes, watching the confidence premium drain away. Externally, analysts asked carefully worded questions on TV, but the subtext was blunt. What does Skilling know that we don't? Because of how sudden it was, theories multiplied. Burnout made sense on the surface. He had spent years pushing a brutal 24/7 culture where sleep was weakness and doubt was treason. But under that explanation lurked something darker. Skilling had seen the real numbers. He knew how much of Enron's reported wealth came from mark-to-market dreams and from off-balance sheet partnerships that hid billions in debt. If the tide of easy credit ever went out, the elegant financial engineering would look less like genius and more like fraud. Let me take you back to that exact moment. The economy was slowing, energy prices were wobbling, and skeptical questions from a few analysts were starting to cut through the hype. It's an example of what happens when a story built on perpetual growth collides with a world that refuses to cooperate. Standing at the top of that fragile empire, Skilling had to see the storm forming. Walking away meant losing power, but it also meant not being the one still in the captain's chair when the hull finally cracked. Ken Lay stepped back in as CEO, presenting the move as a smooth, almost comforting return to stability. To the cameras and town halls, he spoke calmly about continuity, long-term value, and Enron's bright future. Behind closed doors, the scene was very different. Lay was now juggling Sharon Watkins' warning memo, rising concerns from credit rating agencies, and a balance sheet that only worked as long as no one looked too closely. His story is one of polished reassurance layered over growing terror. Publicly, Lay told employees to hold their stock, to trust the leadership, to believe the narrative one more quarter. Privately, he pressed his finance team for fixes, for new structures, for any way to keep the numbers inside the lines. As the market's patience thinned and the economy cooled, Enron's illusion faced its first true stress test without its chief architect on site. The visionary had exited the stage. The mentor was back in charge. And in the harsh light of a skeptical market, the question hanging over Houston was no longer whether Enron could grow, but whether it could even survive the truth that was now closing in. There was a time when Enron walked on water. Wall Street called it untouchable, a modern empire of energy and information, too complex and too admired to fail. But in late 2001, the glow around the company's name began to flicker, and the first people to say it out loud were the ones paid to measure risk. Credit rating agencies had loved Enron's story for years, stamping it with the precious label investment grade. That rating was its passport to money and power. Yet, as the economy cooled and the off-balance sheet maze grew harder to ignore, analysts at Moody's, S&P, and Fitch started asking uncomfortable questions about Enron's high leverage and those strange special purpose entities orbiting its balance sheet. The numbers no longer lined up cleanly with the legend. Let me take you back to those weeks when a single downgrade threat could decide life or death. Enron's trading machine depended on one thing above all: confidence that it would always pay. An investment-grade rating meant counterparties could sign huge, long-dated contracts without losing sleep. But hidden in those same contracts were clauses, tripwires really, stating that if Enron ever lost that rating, banks could demand more collateral, trading partners could terminate deals, and cash would have to move immediately. So when the agencies publicly warned that Enron might be cut to junk, it wasn't just an insult to pride. It was a loaded gun pointed at the company's liquidity. A downgrade would not be a slow slide. It would be a cliff. At the same time, outside the polished conference rooms, a different kind of pressure was building. Short sellers who had long been suspicious of Enron's opaque disclosures started increasing their bets. They noticed that profits looked smooth while the underlying businesses were anything but. That debt kept vanishing into SPEs run by the CFO himself. Skeptical journalists followed with deeper dives into Enron's related party transactions, and those exotic vehicles with friendly names that hid very unfriendly realities. Because of this rising skepticism, rumors became a force of their own. Counterparties quietly reduced exposure, cutting credit lines, shortening contract terms, hedging around Enron instead of through it. Banks, suddenly less charmed by the innovation narrative, demanded more collateral and tighter covenants. Each new request drained cash. Each new article scared another lender. The spiral was fast, and it was ruthless. Enron had been a company built on confidence, and it was now discovering that confidence is the first asset to disappear when people smell smoke. Once counterparties began to doubt, every complex structure that once impressed now looked like a hiding place. What had seemed at times inspiring and at times chilling as financial engineering now appeared simply dangerous. The dominoes were starting to wobble. The rating agencies hesitated. The shorts pressed harder. The banks pulled back. And as the circle of trust shrank by the day, the next revelation would not just shake Enron's image, it would rip open the core of its carefully constructed illusion. Those dominoes didn't just wobble. In October 2001, one of them finally crashed to the floor. Enron, the most innovative company in America, stepped up to a microphone and admitted something it had spent years denying. The numbers were no longer adding up. On October 16, 2001, Enron announced a $618 million loss for the third quarter. Not a tiny earnings miss, not a clever one-time charge. A gaping, blood-red hole. Alongside it came something even more ominous. A $1.2 billion reduction in shareholder equity, tied directly to the special purpose entities that had been quietly propping up the empire. These weren't obscure footnotes anymore. They were now tearing visible chunks out of the company's reported wealth. There was a time when Enron could spin anything. A bad quarter became a transition. A complex deal became innovation. But this time, Wall Street didn't buy the story. The stock, already sliding, plunged more than 20% in a day, then kept falling. Analysts who had once praised Enron's genius started demanding simple explanations. What exactly were these SPEs? How could partnerships outside the company suddenly erase more than $1 billion of shareholder value? Financial reporters who had been circling the story finally smelled open blood. Articles stopped talking about Enron as a visionary trading powerhouse and started asking whether its wealth was a mirage. The focus shifted to accounting, mark-to-market games, opaque disclosures, and those mysterious off-balance sheet vehicles that no one could fully explain on live television without tripping over their own words. Then came an even darker revelation. Many of the SPEs at the center of the equity hit were run by Enron's own chief financial officer, Andrew Fastow. His story is one of a man who designed the maze, then charged a toll to walk through it. The partnerships that were supposedly helping Enron manage risk were also paying Fastow millions in fees, hedging his life against the very danger shareholders were unknowingly absorbing. The conflict of interest wasn't subtle, it was blinding. It's an example of what happens when money, power, and weak oversight collide in the same conference room. Inside Enron, the psychological damage was immediate. Employees refreshed the stock ticker at their desks and watched their retirement savings evaporate in real time. Hallway conversations turned from ambitious deal pitches to whispered questions. Could this be fraud? Was the company still safe? The cult-like confidence that had once made people brag about 80-hour weeks gave way to late-night resume updates, discreet recruiter calls, and a quiet exodus of anyone with options. The building still looked impressive, the lobby still gleamed, but the aura of invincibility was gone. What had seemed at times inspiring and at times chilling as hyper-aggressive capitalism now looked dangerously close to a con. And the cruel twist was this, that October announcement was not the bottom. It was only the first crack. A far more devastating revelation was already on its way, one that would reach back through Enron's history and erase years of supposedly record-breaking profits in a single brutal stroke. That brutal stroke landed on November 8, 2001. Enron stepped up to the microphone and calmly announced that it would go back in time and rewrite its own history, restating its financial results all the way to 1997. In a single press release, years of triumph were downgraded. Reported profits would drop by nearly $600 million. More than $1 billion of debt, once hidden away like a family secret, would finally be dragged onto the balance sheet. There was a time when those same numbers had been paraded as proof of genius. The most innovative company in America, the model for a new kind of energy empire. Now, the company was admitting that those glowing earnings had been built on accounting that did not meet the rules. Special purpose entities that were supposed to be independent were, in reality, controlled by Enron's own executives. Related party deals with Andrew Fasto's partnerships had quietly transferred losses away from Enron while leaving the economic pain with shareholders. Let me take you back to what that meant in plain language. For years, Enron had treated these SPEs like a financial junk drawer, sweeping in bad assets, ugly debt, and failed bets so the main house looked spotless. Because of this ruthless manipulation of appearance, investors thought Enron's life was one of relentless growth, low leverage, and almost magical risk management. The restatement shattered that illusion. The company now admitted that prior financial statements were materially misstated, legal code for the story you were told about this business was not true. On Wall Street, the shock was immediate and chilling. Analysts who had once praised Enron's brilliance now had to explain to clients that years of reported wealth had been distorted. Imagine opening your retirement statement and realizing the company you trusted with your money had been playing accounting games in conference rooms while you were planning your future. It wasn't just Enron's credibility that collapsed. If a $70 billion giant, blessed by elite auditors and adored by the market, could be this hollow, what did that say about everyone else's numbers? Regulators felt the tremor. The SEC, which had already opened inquiries, intensified its investigation, demanding documents, grilling executives, and tracing the maze of SPEs. Lawmakers in Washington began calling hearings, asking how such a large fraud could run for years without being stopped. It was an example of what happens when complexity, charisma, and deregulation collide, at times inspiring and at times chilling in its audacity. But even as the accountants rewrote the past, a more urgent threat was forming in the present. Trading partners saw the restatement and started to wonder if Enron could pay its bills. Lenders studied the new debt numbers and quietly tightened credit. Confidence, once Enron's greatest invisible asset, began to evaporate. And when confidence disappears in a trading-driven empire like this, the next move is rarely gentle. Counterparties reach for the exits, and someone, somewhere, is about to pull the plug. When a trading empire lives on confidence, the real product isn't gas or power contracts. It's belief. And there was a time when almost everyone believed Enron would always find the money. Then the restatement hit, and overnight, belief turned into doubt, and doubt turned into something far more lethal, a liquidity death spiral. Enron's daily life depended on short-term borrowing the way a patient depends on oxygen. The company ran huge trading books in electricity, gas, broadband, even weather, promising to be the market maker for everything. To do that, it leaned on revolving credit lines, overnight loans, and trading lines of credit from banks and counterparties. Cash came in, cash went out, positions were rolled, and as long as lenders kept extending fresh money, the machine looked smooth, efficient, almost invincible. Let me take you back to those first days after the restatement. Banks reread the fine print on credit agreements. Rating agencies sharpened their pencils. Suddenly, those innovative special entities looked like plain old hidden debt. Lines of credit that had always been renewed with a friendly phone call now came with new conditions. More collateral, higher margins, shorter terms, or in some cases, no renewal at all. Because the business was so leveraged to trust, even small changes had huge effects. A falling stock price didn't just hurt executive pride, it tripped debt covenants that forced Enron to post more collateral or buy back obligations in cash. To raise that cash, the company tried to sell assets quickly, which meant accepting lower prices and revealing just how little those assets were really worth. Each disclosure raised more questions, and every answer made the story look worse. It's an example of what happens when a company confuses paper profits with actual solvency. Here's the pattern interrupt moment. On paper, Enron still showed billions in assets and long-term contracts. Yet within weeks, major trading partners refused to face it at all. Energy firms that once begged to be on Enron's platform now limited exposure to zero. The market maker of everything couldn't find a market for itself. In desperation, Enron reached for a savior. Dynegy, another Houston energy player, agreed to a rescue merger that was supposed to stabilize the situation. The announcement briefly slowed the panic. But once Dynegy's team dug into Enron's books, saw the off-balance sheet obligations, the collapsing trading volumes, the sheer scale of the hole, the deal died. Dynegy walked away, its own leaders unwilling to stake their life and family fortunes on a black box. His story is one of apparent wealth masking terminal weakness, at times inspiring and at times chilling. Enron showed how a company can look profitable, powerful, even glamorous, yet still run out of money in days once banks, traders, and investors stopped believing it can pay. When that belief vanished, the empire didn't slowly decline. It simply ran out of runway, and the real crash was about to begin. When the crash finally came, it was not a gentle landing. It was a single date on a calendar. December 2nd, 2001, the day Enron went from Wall Street icon to the largest bankruptcy in American history. Let me take you back to the week before that filing. Creditors were circling, rating agencies were slashing Enron's debt to junk, and the company that once boasted a $70 billion valuation was burning through cash just to survive the next few days. Deals broke down, lifelines vanished, and every phone call from a bank felt like a verdict. There was a time when Enron executives talked about building an empire of global energy and broadband. Now, the only plan left was Chapter 11. On December 2nd, Enron officially filed for bankruptcy protection, listing tens of billions in assets and liabilities in a document that read like the autopsy of a fantasy. Trading operations that had once been celebrated as the Wall Street of energy went dark. Desks that had handled billions in contracts, derivatives, and power deals fell silent in a single weekend. Projects from power plants in India to pipelines in South America were frozen midstream. Contracts suspended. Partners left staring at phones that would never ring again. In Houston, at Enron's gleaming headquarters, the collapse was not abstract. It was cardboard boxes. It was security badges deactivated without warning. It was thousands of employees, many in their 30s and 40s with young families, walking out under that famous crooked E logo, carrying framed photos, coffee mugs, and the last remnants of a life they thought was secure. Stunned faces filled the lobby. people huddled in small knots, whispering about severance, health insurance, and whether their retirement accounts were really gone. Because of the way Enron had encouraged workers to pour savings into company stock, the answer was brutal. Retirement plans that had once shown six-figure balances now displayed numbers that looked like a typo. Years of loyalty, late nights, and belief in the company's story had turned into poverty risk almost overnight. Meanwhile, at the top, the contrast was chilling. Senior executives had already cashed out hundreds of millions of dollars in shares, while publicly urging employees to keep buying and hold steady. The people with the most information had quietly moved their money off the ship. The people with the least went down with it. It's an example of what happens when power, image, and creative accounting outrun reality. Enron's fall was not just a corporate failure. It was a human catastrophe, playing out in office hallways and living rooms across America. And yet, December 2nd was not the end of the story. It was the opening shot in a reckoning that would soon engulf auditors, regulators, and some of the most respected names in corporate America, exposing just how many people had helped build the illusion. There was a time when working at Enron felt like winning the corporate lottery. The stock kept climbing, the media called it a miracle, and inside the glass towers in Houston, employees were told a simple story. Believe in the company, and the company will take care of you. For thousands of families, that promise would turn into ash. Enron didn't just encourage loyalty, it financialized it. The company urged workers to pour their 401k retirement savings into Enron stock, praising those who went all in on the empire they were helping to build. Contributions were often matched, not with cash, but with more Enron shares, creating a retirement plan that looked impressive on paper and terrifyingly fragile in real life. When the stock soared, employees felt rich. When it fell, they discovered they had been standing on a single crumbling pillar. Then came the cruel twist. In the fall of 2001, as rumors spread and the stock began to slide, Enron announced a change in plan administrators. A routine, technical change, executives said, harmless. But during that transition, employees were locked out of their 401k accounts, unable to sell their Enron stock for weeks, while the price collapsed day after day. At the same time, senior executives with far better information and far more power were quietly cashing out hundreds of millions. Let me take you back to one of those employees, a mid-level manager who had spent 20 years at Enron and had nearly all of his savings in company shares. On paper, he once had close to $1 million set aside for retirement. By the time the trading freeze ended, that life savings had shrunk to almost nothing. Another worker, a secretary who had never made more than a modest salary, watched the value of her account drop so low she joked dryly that Enron had finally solved her tax problem. There was no money left to tax. Retirees fared no better. Some had already left the company, believing the stock in their 401ks and pension plans would carry them through old age. Instead, they lost homes, delayed medical care, moved back in with children, and returned to work in their 60s and 70s, not for purpose, but for survival. It's an example of what happens when a culture of ruthless financial engineering meets ordinary people who trusted the story they were told. Soon, these private tragedies spilled into public view. In congressional hearings, former employees sat under bright lights and told lawmakers how they had spent years selling Enron's vision to investors, neighbors, and friends, only to be wiped out while executives protected themselves. Their loyalty was total. The protection they received was zero. Because of that imbalance, Enron's fraud was not a victimless accounting game. It was a giant transfer of wealth, from workers and small investors to a small circle at the top. And as investigators dug deeper, they would discover that Enron's leaders did not do it alone. Investigators followed that trail of damage, and found something even more unsettling. Enron's numbers had been blessed, year after year, by one of the most prestigious accounting firms on earth. There was a time when the name Arthur Andersen meant trust, discipline, and almost old-fashioned respectability. Now, the question hanging in the air was brutal. How did the watchdog become an accomplice? To answer that, let me take you back to the fall of 2001. As the SEC and Congress began asking hard questions, partners and staff inside Andersen's Houston office reacted, not with transparency, but with a flurry of activity around paper shredders and delete keys. Thousands of Enron-related documents were destroyed just as inquiries were heating up, a frantic effort to erase the paper trail behind those innovative deals. For a firm that claimed to worship the audit file, it was like watching a priest burn the scriptures on the church steps. Because of that shredding, the investigation into Andersen's role shifted from negligence to something darker. Prosecutors argued that this was not a mistake, it was obstruction. In 2002, the U.S. Department of Justice indicted Arthur Andersen for obstructing justice, saying the firm had deliberately destroyed evidence to hinder the Enron probe. One criminal charge against a single partnership, but the impact was immediate and devastating. Clients fled. Banks, manufacturers, tech companies, anyone who needed clean financials did not want the auditor whose last big job ended in handcuffs. Within months, Arthur Andersen's global empire of offices, once auditing giants and governments, began to disintegrate. Partners defected to rivals. Teams were bought out. The brand that had taken nearly a century to build evaporated in what felt like a long weekend. Even when the U.S. Supreme Court later overturned the conviction on technical grounds, the victory was hollow. The firm was already effectively dead. Its 80-year life ended not by poverty, but by a few weeks of ruthless document destruction and years of compromised independence. Symbolically, the fall was enormous. Not only had Enron collapsed, one of the big five accounting firms had gone with it. It was an example of what happens when the referee decides to join the game, when fees from consulting and advisory work become more important than telling the truth about the numbers. For other auditors, the message was chilling. If Arthur Andersen could vanish, anyone could. Across the industry, standards tightened. Firms split off consulting arms. Partners reevaluated every cozy relationship with audit clients, and the casual, clubby world of boardrooms and rubber-stamped opinions suddenly felt dangerous. Careers, money, even entire firms were now visibly on the line. And into that fear stepped lawmakers. Seeing public outrage and a wounded profession, they finally had the momentum to push through sweeping reforms, rules that would reshape how public companies report their finances. The next chapter of this story is not just about Enron or Andersen anymore. It is about a law that still governs every earnings call you hear today. There was a time when Wall Street believed the market could police itself, when boards, auditors, and rating agencies were supposedly enough to protect your money. Enron, WorldCom, and a wave of early 2000s scandals shattered that illusion in real time, wiping out pensions, destroying careers, and exposing a corporate empire built on sand. So in 2002, Washington struck back with a law whose very name still makes executives sit up straighter, the Sarbanes-Oxley Act. Signed by President George W. Bush, it was Congress's answer to the question everyone was suddenly asking: how do you stop another Enron before it starts? The answer was blunt: make the people at the top own the numbers. Personally. Under Sarbanes-Oxley, the CEO and CFO can no longer hide behind layers of accountants and lawyers. They must certify that the company's financial statements are accurate, that internal controls are effective, that the story being told to investors reflects reality. If those numbers are false, it is not just a bad headline anymore. it is a crime with real prison time attached. Section 404 became the most feared line in the law. It forces companies to build and test detailed internal controls over financial reporting, to document who approves what, who can move money, who can override the system. Auditors must then attest to those controls. For Enron, whose life depended on shifting debt into hidden entities and massaging earnings with mark-to-market tricks, this kind of X-ray vision would have been lethal. But Sarbanes-Oxley did not stop at the company walls. It went straight at the auditors too. Remember Arthur Andersen happily collecting millions in consulting fees from Enron while also signing off on its books. That conflict of interest was no accident. It was a business model. The new law sharply limited how much consulting work an audit firm can do for the same client, trying to make sure the watchdog is not also the family's paid decorator. To enforce all this, Congress did something the profession had fought for decades. It created a new regulator above the auditors themselves. The Public Company Accounting Oversight Board, the PCAOB, now inspects audit firms, writes standards, and can punish failures. In a quiet way, it ended the era when the big firms largely governed their own conduct. Yet, as with Enron, the story is at times inspiring and at times chilling. Sarbanes-Oxley made corporate life more transparent, raised the personal stakes for fraud, and reminded executives that power comes with handcuffs, not just bonuses. But it also made compliance expensive. Complex testing, documentation, and PCAOB-approved procedures land harder on smaller companies than on global giants, leading some to argue that a law born from one empire's collapse may have unintentionally helped larger firms entrench their wealth. And even with all these new rules, one question still hangs in the air. Can any law truly restrain greed, or does it merely change the way the game is played? The next phase of this story will show how markets tried to answer that. There was a time when Enron's leaders were praised on magazine covers, not paraded into courtrooms in handcuffs. Now the empire they'd built on illusions was gone, and the question hanging over everything was simple and brutal. Who would pay for the lies that had vaporized billions in wealth and shattered so many lives? Prosecutors answered with three names: Kenneth Lay, Jeffrey Skilling, Andrew Fastow. Not only were they charged with conspiracy, securities fraud, and insider trading, they were accused of running a long, deliberate campaign to deceive markets, prop up Enron's stock price, and quietly dump their own shares before the truth hit. It wasn't just a bad quarter or a few rogue trades. It was, according to the indictments, a criminal business model. Fastow, the architect of the off-balance sheet maze, faced dozens of counts. The money he'd pulled from the LJM partnerships and Raptors, the self-dealing, the hidden guarantees, all of it was laid out in chilling detail. Looking at decades in prison and the wreckage looming over his family, he finally broke. He pleaded guilty to conspiracy and wire fraud, agreed to forfeit millions, and crucially agreed to talk. That decision changed everything. Fastow walked prosecutors through the SPEs from the inside, explaining how mark-to-market accounting turned guesses into profits, how LJM was used to park losses, while executives publicly bragged about Enron's strength, how top leadership knew the reality behind the glowing numbers. He described meetings where risks were waved away, where inconvenient questions were treated as disloyalty. Dry spreadsheets suddenly became a human story of ambition, fear, and loyalty to the wrong people. Then came the main event, the Lay and Skilling trial in Houston. Jurors heard experts explain mark-to-market in plain language, showing how a 20-year energy contract could become instant income with a few optimistic assumptions. They saw diagrams of LJM and the Raptors, those exotic names masking very old ideas. Debt hidden inside vehicles, losses pushed into dark corners, executives cashing out while the public bought in. Internal warnings surfaced. Emails from employees raising red flags, risk memos questioning the structures, early concerns about Fasto's conflicts of interest. The defense argued that Enron was a complex, innovative company undone by a crisis of confidence and a brutal market turn. The prosecution countered that the innovation was a costume for fraud. It was an example of what happens when a culture worships the stock price and treats truth as a negotiable expense. The verdicts were devastating. Skilling was convicted on multiple counts of fraud, conspiracy, and insider trading. Lay was found guilty too, but died of a heart attack before sentencing, his story frozen between conviction and punishment. Fasto, once the ruthless dealmaker, received a reduced sentence for his cooperation. Yet, beneath the courtroom drama, a harder question lingered. Had justice really captured the full system that enabled Enron, or just pinned blame on three men in a much larger machine? The next chapter of this story looks at who escaped the spotlight and why that still matters. Had justice really captured the system, or just three faces to put on the evening news? There was a time when the answer felt simple. Lay, Skilling, and Fasto were the villains, full stop. The greedy masterminds who torched an empire for money and power. It made for a clean story. Too clean. Inside Enron's towers, the picture looked different. Colleagues remembered Ken Lay as the soft-spoken chairman who asked about their family, who talked about values and community, who wrote personal notes when someone had a child or a crisis. Jeff Skilling was described as electric in a room, pacing in front of whiteboards, selling a vision of transforming a sleepy pipeline company into the most innovative energy firm on earth. Andrew Fasto, before he became the symbol of fraud, was seen as the brilliant numbers guy who could structure any deal, solve any problem, make the impossible work. To many who worked under them, his story is one of at times inspiring and at times chilling leadership. So how do people who talk about ethics at town halls end up running one of the biggest frauds in American history? Cognitive dissonance filled the gap. When mark-to-market accounting let them book 20 years of profit on day one, they could tell themselves the cash would arrive later. When special purpose entities buried billions in debt, they could argue they were just smoothing volatility until real performance caught up. Quarter after quarter, they were not lying. They were managing expectations, buying time, protecting shareholder value. Each phrase shaved off a little guilt. Let me take you back to the late 1990s. The dot-com bubble was swelling. Companies with no profits were valued in the billions, and Wall Street worshipped one god, the quarterly earnings call. Miss the number and your stock was punished. Hit it or beat it by a penny, and you were rewarded with more capital, more prestige, more power. Financial engineering was not a dirty word. It was a skill set. Enron was not alone in playing accounting games. It was an example of what happens when every incentive, every bonus plan, every headline screams that the only thing that matters is this quarter's stock price. Under that pressure, how many executives would be tempted to edge the line if they believed everyone else was doing it too? When competitors brag about innovative structures, when analysts reward aggressive forecasts, when regulators lag years behind, the distance between aggressive and fraudulent begins to blur. If Enron was not just a cause, but a symptom of its time, the uncomfortable question is obvious. Where are the Enrons of today, still hidden in plain sight, waiting for the moment when the numbers finally stop working? There was a time when the warning lights around Enron were so bright they should have blinded anyone holding the stock. Yet the market kept applauding, the executives kept cashing out, and the empire of numbers kept growing. To see how that happened, you have to slow the story down and look at the red flags everyone saw, and almost everyone explained away. Start with the numbers. On paper, Enron's net income was soaring quarter after quarter. But the cash coming in from operations, the actual money generated by the business, lagged far behind. That gap between net income and operating cash flow was not a tiny technicality. It was a siren. Profits were being booked up front through mark-to-market accounting, while the cash might arrive years later, or never. It's an example of what happens when reported wealth becomes more important than real cash. Then there were the shadows on the balance sheet. Enron relied on hundreds of off-balance sheet entities, special purpose vehicles engineered to hold debt and losses where investors would not easily see them. Many of those entities were run by the same man who was supposed to protect shareholders, CFO Andrew Fastow. The related party disclosures in Enron's filings describe these arrangements in dense technical language, but the core reality was simple and chilling. The man controlling the numbers was also on the other side of the deals, taking fees, skimming gains, and hiding risk. Governance was supposed to be the backstop. Instead, the board of directors approved Fastow's conflict-ridden partnerships, waived internal rules that should have blocked them, and allowed risk committees that met rarely and probed gently. Compensation was wired to short-term stock performance, with bonuses tied to deal volume and mark-to-market gains, not to long-term stability or honest cash flow. When a company pays people to make the chart go up this quarter, many will not ask what happens next year. Outside the building, the market behavior was just as revealing. Wall Street analysts called Enron the most innovative company in America, even while admitting, sometimes on the same conference calls, that they did not fully understand its business model or its financial statements. The opacity became a feature, not a bug. If you did not get Enron, the implication was that you simply were not smart enough. Here, the psychology turns at times inspiring and at times chilling. Confirmation bias and greed pulled sophisticated players into the same trap that snares small investors. Rising prices proved the story was true. Doubts were dismissed as old thinking. Pension funds, employees, and banks all told themselves that this was just the price of innovation, that real genius always looks strange at first. So, what can an individual do differently? The practical takeaway is ruthless simplicity. When looking at any company, compare net income to operating cash flow over several years. If profits grow but cash does not, be skeptical. Scan the notes for related party transactions and off-balance sheet obligations. If the same names appear on every side of every deal, walk away. Watch how leadership behaves. A board that rubber stamps, a culture obsessed with stock price, a CEO who attacks critics rather than answers questions. Pattern interrupt. Imagine being an employee whose retirement sits in company stock while executives quietly sell their shares. That disconnect between words and actions is a red flag louder than any footnote. Let me take you back to Enron's final year, when those contradictions began to collide with reality and the mirage finally met the cash register. In that final year, Enron wasn't improvising. It was running a playbook, a script for how to turn a struggling business into a $60 billion mirage, then convince the world it was an empire of pure genius. There was a time when every great fraud began the same way, with a story. Enron's story was irresistible. Old pipeline company reborn as the future of energy, trading, broadband, even weather. Endless growth, unlimited markets, risk conquered by math. The message to Wall Street was simple and seductive. This isn't just a company, it's a new kind of machine for making money out of thin air. Once the story was in place, the accounting engine went to work. Using mark-to-market rules, Enron booked the entire projected profit of a 20-year contract on day one, long before the cash arrived, if it ever would. A power deal in India, a broadband swap, a complex derivative in some distant market could be turned into instant earnings with a few spreadsheet assumptions. Profits were dragged forward, reality was pushed back, and every quarter looked at times inspiring and at times chilling in its smooth perfection. But smooth lines hide violent swings. To bury the volatility and the losses, Enron flooded the landscape with special purpose entities, off-balance sheet partnerships that quietly absorbed bad bets and ugly debt. Many were run by its own CFO, Andrew Fastow, who was paid on both sides of the table. If a project soured, it vanished into one of these vehicles, leaving the main financial statements looking clean, confident, almost untouchable. The complexity wasn't a bug, it was a weapon. Enron wrapped its moves in dense jargon about value-at-risk models, bandwidth trading, and structured finance so layered that even seasoned analysts felt outgunned. Question the numbers, and the response was a smirk, a lecture, and a reminder that only the truly sophisticated could grasp the magic. It's an example of what happens when intimidation dresses itself up as intelligence. To protect the illusion, the gatekeepers had to be captured. Auditors earned rich fees and consulting contracts. Analysts were rewarded with access, private briefings, and the thrill of being close to the most innovative company in America. Rating agencies saw the same glossy story, the same managed earnings, and kept investment-grade labels on a business that was quietly bleeding cash. Because of this quiet capture of referees, the game stayed rigged long after the scoreboard stopped matching reality. And when reality finally diverged too far from the narrative, the response was not to pull back, but to double down. More entities, more engineering, more desperate deals, each one designed to buy a few extra months of belief. It worked until it didn't. Let me take you back to what happened next, because this playbook did not die with Enron. Variations of it would reappear in mortgage-backed securities, in shadow banks, in crypto bubbles promising effortless wealth. The names changed, the jargon evolved, but the script remained. In the next part, that script meets its first real test. A whistle, a question, and a crack in the facade that no amount of engineering could seal. That crack in Enron's facade was not just the end of one company. It was an early tremor, a warning shot that echoed forward into the next decade, where the same hunger for money, the same worship of complexity, would help bring the global financial system to its knees. There was a time when Enron's off-balance sheet entities seemed like a one-off monstrosity, a bizarre accounting carnival that only a few ruthless executives and clever lawyers could dream up. But let me take you back to the early 2000s, as banks quietly built their own shadow empires. They called them structured investment vehicles and conduits, parked just far enough away from the balance sheet to look harmless, but close enough to funnel risk right back into the heart of the system. Like Enron's SPEs, these SIVs bought long-term, risky assets with short-term, supposedly safe funding. Mortgage bonds, subprime loans, exotic slices of debt were piled up out of sight, while banks told investors their own books were clean. The risk didn't disappear, it was simply moved to another room, locked behind a door labeled off-balance sheet, and everyone agreed not to ask what was inside. Enron had pioneered mark-to-market games, booking decades of imagined profits on day one. Before 2008, Wall Street took that same mindset and applied it to mortgage-backed securities and complex derivatives. If a model said a bundle of home loans was worth a fortune, then on paper it was. Never mind that those loans were made to borrowers with no income, no documentation, and no realistic path to repay. The spreadsheet said wealth, so the bonus pool said yes. Incentives told the real story. Enron traders were paid for deal volume and reported earnings, not durable value. A few years later, mortgage brokers, investment bankers, and traders lived the same life. Close the loan, create the security, sell the collateralized debt obligation, collect the fee. Ratings could be shopped, assumptions could be nudged, and anyone who questioned the chain was told that housing prices, like Enron stock once, would never truly fall. The referees failed again. Regulators, just as they had with Enron's complex partnerships, often lacked the tools or the will to challenge what they were seeing. Rating agencies stamped AAA on securities they barely understood, paid by the very banks whose products they were grading. Complexity became a shield, a way to say, trust the models, while the real world quietly drifted away from the equations. It's an example of what happens when systems change on paper faster than they change in practice. After Enron, Sarbanes-Oxley tightened controls, demanded more disclosure, promised a new era of transparency. Yet, within a few short years, a different corner of finance had rebuilt the same fragile architecture, this time on a global scale. His story is one of warning, but the lesson was only half absorbed before the next storm arrived. In the next section, that storm finally hits, and the illusions around housing, leverage, and untouchable wealth begin to shatter in real time. There was a time when investors believed the age of accounting tricks had ended, that Sarbanes-Oxley and new watchdogs had slammed the door on Enron's ghost. Yet, in the glow of screens and the rush of venture money, a familiar figure quietly reappeared, the charismatic founder promising a new world, asking everyone to ignore the numbers right in front of them. In the high-growth tech and startup scene, the mantra became blitzscaling. Grow first, explain later. Companies lost money on every user, on every ride, on every delivery, and called it investment. Losses were framed as proof of ambition, not warning signs. When that story is honest, it can build real empires. When it drifts, it can slide into something at times inspiring and at times chilling, where projected lifetime value replaces present reality and the line between optimism and misrepresentation starts to blur. So founders learned a different language, not profit, but adjusted EBITDA. Not cash, but run rate revenue. Not churn, but net expansion. Numbers were shaved, stretched, and relabeled, all while remaining technically disclosed. Some fast-growing companies were accused of counting the same user multiple times across apps, of celebrating bookings that never became money, of showcasing non-GAAP metrics on page 1, while the ugly truth sat in the footnotes. It was legal, often, but the spirit felt familiar. If the story looked good enough, the market would not ask too many questions. Around them, whole sectors turned complexity into a moat. In fintech, intricate lending algorithms and bundled products made it hard to see where the real risk lived, or who would be left holding the bag when the cycle turned. In crypto, white papers and tokenomics promised new forms of wealth and power, while balance sheets leaned on self-issued tokens priced by the same markets they could quietly influence. Certain biotech ventures spoke in dense scientific language, multi-arm trials, and conditional endpoints that most outsiders could not decode, even as valuations soared far ahead of proven results. In each case, the pattern echoed Enron's life. Complexity became a shield, not a tool. Leaders brushed off skeptics as dinosaurs who didn't get it, just as Skilling once did, turning doubt into a badge of honor among the faithful. The financials lagged behind the legend, and the legend kept marching anyway. When a company's story demands exponential growth forever, but the cash flows whisper something weaker, that whisper is usually telling the truth. So if Enron was a one-time scandal, its spirit is not. It lives wherever narratives run ahead of numbers, wherever family savings depend on models no one outside the building can explain. Yet the fog is not impenetrable. The tools to see through it already exist. Simple questions, plain language explanations, and a refusal to be dazzled by jargon. The real test is whether anyone is willing to ask those uncomfortable questions before the music stops. In the next section, those questions finally collide with reality, and the cost of looking away becomes impossible to ignore. The fog lifts, and what appears isn't a monster in a mask, but something far more unsettling. Ordinary people, doing their jobs, telling themselves they are still the good guys. There was a time when Enron's fraud did not look like fraud at all. It looked like smoothing out a bad quarter, using the flexibility of mark-to-market, or parking a little extra debt in an outside partnership until the market caught up to Enron's true brilliance. It starts small. A trader books aggressive profits on a 20-year energy contract, knowing the cash will not show up for years. An accountant nudges an assumption so the numbers land exactly on Wall Street's target. A finance executive helps create one more special purpose entity, telling himself it is temporary, that when prices rise, the deal will be unwound, the balance sheet cleaned, the house put back in order. Then the quarter ends, the stock pops, the bonuses hit. No one wants to undo the magic trick that just made everyone richer. Inside the empire, a shared script develops. Everyone does it. The competitors use the same tricks. The rules are outdated, and Enron is simply ahead of its time. Executives tell themselves they are protecting shareholders, protecting employees, protecting the company's innovative reputation. Revealing the full truth would cause panic, crush the share price, wipe out retirement accounts. So the lie becomes an act of mercy. It's an example of what happens when fear dresses itself up as virtue. Success pours gasoline on that fire. For years, the market rewards Enron's numbers. Analysts call it the most innovative company in America. The stock price soars toward $90. Deals that should never have worked seem to work, at least on paper, and each lucky escape convinces leadership they can outsmart markets, auditors, even physics. Let me take you back to those conference rooms where Jeff Skilling and Andrew Fastow present yet another structure that hides billions in debt. The more complex it looks, the more brilliant they feel. At times inspiring and at times chilling, their confidence turns into a kind of religion. Most people inside never see the whole picture. A junior lawyer drafts boilerplate language. A mid-level accountant reconciles one narrow slice of an SPE. A risk manager signs off on assumptions already blessed by someone higher up. Compartmentalization becomes a shield. Each person only touches one piece of the machine, so no one feels responsible for what the machine does. Here is the uncomfortable part. These are not alien motives. The desire to look successful, to protect a job, to avoid bad news, lives in every organization and in every career. His story is one of fraud on a grand scale, but the psychology behind it is painfully familiar. Recognizing those early rationalizations in a boss, in a company, in the mirror, is the first weak line of defense. In the next section, that line finally snaps, and the stories people told themselves collide with a reality that can't be smoothed, hidden, or deferred to the next quarter. when those private stories finally collide with reality. There is supposed to be a referee on the field. Not just one, but an entire layer of them. Regulators, rulemakers, watchdogs. In theory, they stand between a company's hunger for money and the public's need for truth. In practice, when Enron rose, the referees were badly outnumbered. There was a time when the Securities and Exchange Commission oversaw a market far simpler than the one Enron played in. By the late 1990s, that world was gone. A few thousand staff at the SEC were expected to police thousands of public companies, tens of thousands of complex filings, and a wave of financial engineering that mutated faster than any rulebook. Mark-to-market accounting, exotic derivatives, off-balance sheet vehicles, Enron's empire of numbers expanded in 3 dimensions, while the referee worked with a flat whistle and a shrinking budget. Let me take you back to those years when Enron was crowned the most innovative company in America. The same political system that was supposed to empower regulators was quietly declawing them. Enron and its peers spent millions lobbying for lighter oversight of derivatives, for more flexibility around special purpose entities, for accounting rules that treated long-term guesses like present-day wealth. Because of that pressure and a broader faith in deregulation, energy trading was liberalized, derivatives slipped into the shadows, and off-balance sheet entities became a fashionable way to hide risk rather than a red flag. It's an example of what happens when the regulated write the script for the regulator. When Enron finally imploded, the response was fierce. Congress passed the Sarbanes-Oxley Act, enforcement budgets went up, executives suddenly faced prison time for signing false accounts, and internal controls became a daily fact of corporate life. Whistleblowers like Sharon Watkins inside Enron went from ignored troublemakers to protected figures, with new laws promising retaliation would be punished. On paper, the system looked tougher, smarter, less trusting of executive charm. But even after those reforms, the asymmetry remained. Companies can innovate in secrecy, move capital overnight, spin up hundreds of entities in tax havens or legal gray zones. Regulators must move slowly and transparently, propose rules, take comments, fight lawsuits, beg for appropriations, and then, only then, knock on the door. By the time they arrive, the damage is often baked in, pensions already destroyed, employees already in poverty, executives already on a beach, enjoying their wealth. Because of that structural gap, every Enron creates its own shadow. Each new product, each new market, each new accounting trick appears first inside a boardroom, not a rule book. And if the referee can't be everywhere at once, and the auditor can be captured by fees, relationships, or the promise of future business, then a darker question emerges, one that hangs over the rest of this story. If the watchdogs are always a step behind, who actually protects the investors and employees standing on the edge of the next invisible cliff? If the watchdogs are always late to the scene, then the only real barrier between a company and another Enron is what lives inside the walls every day. Culture. Not the slogans in the lobby. The unwritten rules about fear, money, and power. There was a time when Enron's headquarters felt like the center of a new financial empire. Skilling preached rank and yank. Employees were graded, stacked, and cut. Miss a target, lose your bonus, lose your job. Short-term deals, short-term profits, short-term loyalty. Questioning the numbers was career suicide. Dissent was mocked, not rewarded. It's an example of what happens when fear plus greed becomes the operating system. Now let me take you back to companies that chose a different path. At Toyota, after deadly safety recalls. At Johnson & Johnson, after the Tylenol poisonings. Leaders didn't just issue press releases. They paid real money to fix real failures, invited brutal internal criticism, and told employees, in effect, if you hide bad news, you are the problem. Psychological safety wasn't a TED Talk phrase. It was the only way to avoid killing customers twice. The mechanisms look boring on paper, but they decide who sleeps at night. Independent ethics hotlines that don't report into the same executives whose numbers are being questioned. Compliance officers who can stop a deal, delay a launch, or go straight to the board without asking permission. Boards that don't just tolerate whistleblowers, but quietly promote them, protect their careers, and treat early warnings as assets, not betrayals. Incentives are where the mask really slips. Enron paid massive cash bonuses on this quarter's profits, many of them mark-to-market fantasies that might never turn into cash. When the game is hit the number today or vanish. Fraud is not a bug, it is a rational survival strategy. Companies that last tie wealth to time. Multi-year bonuses that only vest if results hold up. Clawback provisions that pull back pay when earnings are restated, and performance metrics that include safety, customer trust, and employee retention, not just stock price and EPS. His story is one of, at times, inspiring and at times chilling turnarounds. After LIBOR rigging scandals and money laundering fines, some banks rewired pay so individual traders could not earn fortunes on risks that would explode years later. After its emissions scandal, Volkswagen tied executive compensation to compliance and carbon goals, not only to sales. None of this made them saints, but it made cheating less profitable. So here is the uncomfortable mirror for the viewer. In any workplace, the real culture is revealed by two questions: who gets promoted, and what happens to the person who says, "This looks wrong"? Are the heroes the rainmakers who hit impossible targets by any means necessary, or the ones who slow the deal down until the numbers make sense? The answer decides whether the next Enron is impossible or already quietly in progress. And as the Enron story races toward its breaking point, those answers are about to be tested in the most public way possible. The answers are about to be tested in public, but the real test is much quieter. It happens in living rooms, retirement accounts, and trading apps. Because Enron isn't just a story about executives in Houston. It is a mirror held up to anyone who ever thinks, that company is unstoppable, what could go wrong? There was a time when Enron employees said that about their own empire. Many had their retirement almost entirely in Enron stock. They worked there, they were paid in shares, they watched the price soar toward a $70 billion valuation and felt rich on paper. Then the fraud cracked, the price collapsed to pennies, and years of life savings vanished with a few trading halts and one bankruptcy filing. That is what concentration risk looks like when the music stops. So the first brutal lesson is simple. Never let your future depend on one company's stock, especially your employer's. Loyalty does not diversify risk. A paycheck is already a giant bet on that business. Piling your retirement on top of that is not confidence, it is leverage on your own life. Diversification feels boring when everything is going up. It feels like survival when one name suddenly goes to zero. The second lesson is about complexity. Enron was sold as a genius-level machine that ordinary people could not possibly understand. Energy trading, bandwidth markets, mark-to-market accounting, hundreds of special purpose entities with names that sounded like science fiction. If anyone asked for a plain English explanation, they were treated as if they just did not get it. That aura of mystery was not a feature of brilliance, it was a shield. So treat complexity as a risk factor, not a compliment. If a business cannot be explained in a few clear sentences, if its profits depend on opaque models and off-balance sheet arrangements that only insiders claim to grasp, that is a warning light. Real wealth comes from cash moving through the real world, not from numbers that exist because a spreadsheet says they do. That leads to the third lesson. When looking at a company, do not only watch the stock chart or the growth story. Look at cash flow. Are they actually pulling in cash or just reporting earnings while borrowing more and more money in the background? Look at the balance sheet. Is debt quietly piling up in corners, or is the foundation strong? And look at governance. Who is on the board? Who signs off on the audits? Who benefits from the deals? It is an example of what happens when conflicts of interest are treated as a clever trick instead of a red flag. There was a time when annual reports were doorstops. Today, they are survival manuals. Reading them, following independent journalism that is not paid to be optimistic, watching how leaders react when analysts ask hard questions. These are practical habits, not hobbies. When a CEO mocks skeptics instead of answering them, when numbers get more complex as reality gets worse, that is the market whispering, "Pay attention." Because his story is one of power abused on a grand scale, at times inspiring and at times chilling in its audacity. But Enron's real impact is not just in court transcripts and ruined careers. Its power lies in how it can quietly change the way you see every future investment opportunity, and in what happens next when a new can't-fail company starts to look strangely familiar. So let's clear something up right away. Enron was not an empty warehouse with a neon sign. There was a time when parts of this company were genuinely world-class, genuinely profitable, and even genuinely useful. In the 1990s, Enron helped pioneer modern energy trading. It built markets where none really existed, turning long-term gas contracts into liquid, tradable instruments. Power plants, utilities, and industrial customers could finally hedge prices instead of gambling their entire budget on next winter's weather. For a brief moment, this wasn't just a con. It was innovation, real money, real value. Then the empire decided that real profits were too slow, because once Wall Street crowned Enron the most innovative company in America year after year, the pressure changed. The early trading success became the foundation for something far more ruthless: mark-to-market games, off-balance sheet debt, and deals designed not to serve customers, but to hit earnings targets. The honest engine that could have been a solid business was buried under an avalanche of fake performance. Another myth is that Enron's collapse was a lightning bolt from a clear blue sky. It wasn't. The warning signs were there for years, blinking red. Analysts kept asking why Enron showed soaring profits, but almost no cash. Journalists like Bethany McLean publicly questioned how the company actually made its money. Insiders saw a culture where bad news was punished, where do the deal mattered more than does it work. The structure itself was fragile: huge leverage, complex entities, and a dependence on ever-rising stock to plug yesterday's holes. When the music stopped in 2001, it looked sudden. In reality, the life of Enron had been hollowing out for a long time. The market just finally noticed. It is also a mistake to think of Enron as only an accounting scandal, as if a few crooked spreadsheets brought down a giant. This was a cultural failure inside the company, where arrogance was celebrated and doubt was treated as disloyalty. It was an ethical failure where executives cashed out hundreds of millions while employees watched their pensions evaporate. And it was a systemic failure where banks, lawyers, and rating agencies helped design, bless, and distribute the very products that hid the truth. Then came Sarbanes-Oxley, the great legislative hammer: tighter controls, certifications, criminal penalties. Many people like to believe that this law fixed everything. It didn't. It made fraud harder in some ways, more bureaucratic in others, but it did not erase the incentives that reward short-term stock price over long-term reality. Complex derivatives still thrive. Off-balance sheet obligations still exist. Charismatic leaders still sell grand stories about limitless growth. Here is the pattern interrupt. Enron is not best understood as a cartoon villain that the system heroically defeated. It's an example of what happens when a seductive narrative, weak oversight, and the hunger for wealth and power all line up perfectly. His story is one of power abused on a grand scale, but also of systems that quietly allowed it. And as the next can't-fail company rises, the real question becomes, how much of Enron's world ever truly went away, and how much merely changed its name? There was a time when a company could hide billions behind opaque partnerships, cozy auditors, and a handful of print journalists trying to keep up. Enron thrived in that world. But if the same empire of numbers tried to rise today, it would face a landscape that looks very different on the surface and disturbingly familiar underneath. After Enron, Congress swung hard. Sarbanes-Oxley slammed new locks on the corporate vault. CEOs must personally certify financial statements. Internal controls have to be documented and tested, and destroying audit evidence can send people to prison. The creation of the PCAOB put auditors under their own regulator, inspecting their work papers, questioning their judgments, threatening their licenses. A modern Arthur Andersen would have someone looking over its shoulder while it looked over the clients. That alone might slow the most brazen games. Whistleblowers also live in a different world. There are now hotlines, anti-retaliation rules, and SEC bounty programs that can pay millions to anyone who exposes a major fraud. A modern Sharon Watkins wouldn't just be sending memos to the corner office. She could quietly walk into a regulator's life and change it. That doesn't guarantee courage, but it does change the math of fear, loyalty, and money. Yet while the guards improved, the maze got more complex. Global supply chains stretch across continents, with shell companies, joint ventures, and related parties scattered through tax havens and legal gray zones. Balance sheets are now dominated by intangibles: software, data, brands, user relationships, token holdings. When most of the value lives in ideas and code, it becomes easier to argue that almost any number is reasonable, and harder for outsiders to prove that it isn't. On top of that, algorithmic trading and high-speed hedge funds can turn a shaky story into a soaring stock price. When machines are buying because the chart looks strong, the news sentiment is positive and the user metrics are up and to the right. Underlying weakness can stay hidden longer. Momentum can impersonate fundamentals for a very long time. Social media and alternative data add another twist. On one hand, there are armies of online sleuths, short sellers posting 80-page threads, satellite images of empty parking lots, web-scraped pricing feeds, app download charts. Red flags that once took months to surface can now explode in a weekend. On the other hand, hype travels even faster. Influencers, anonymous accounts, glossy founder interviews can turn a fragile business into a cultural event, drowning out the few voices asking how the company actually makes money. So the modern fraud doesn't always lean on fake earnings alone. It leans on non-GAAP metrics, adjusted EBITDA, community engagement, daily active users, token economics, and on-chain jargon that promise future wealth while quietly sidestepping present reality. His story is one of old greed dressed in new language, at times inspiring and at times chilling to watch, when early believers really do get rich. Let me take you back to Enron's mark-to-market tricks and off-balance sheet entities. Now imagine them rebuilt as aggressive revenue recognition in a streaming app, or as a web of offshore crypto foundations and liquidity pools. The tools for deception have multiplied. So have the tools for detection. For every new way to hide risk, there is a new dataset, a new model, a new whistleblower channel waiting to expose it. The real question is, which side is moving faster? And what happens when the next Enron discovers the answer first? And this is where the story stops feeling historical and starts feeling uncomfortably current. Because Enron didn't just vanish into the early 2000s, it left a shadow long enough to stretch over every boardroom table on Earth. There was a time when Enron meant innovation, energy trading, a gleaming empire of glass towers, and limitless growth. Today, the name functions as a warning label. Business schools dissect it case by case, slide by slide, teaching future executives how a company valued at more than $70 billion could implode in weeks. Law schools map every special purpose entity. Accounting programs replay mark-to-market games line by line. Enron became the default exhibit for what happens when governance fails, and everyone at the top convinces themselves the rules are optional. Let me take you back to a modern board meeting. The agenda says new revenue opportunity or creative financing. The language is clean. The slides look safe. Then someone leans back and says two words that freeze the room. Remember Enron. Directors and executives still use it as shorthand when they debate how much risk to take, how much disclosure to give, how aggressive the accounting can be without detonating trust. It's the uninvited guest at every conversation about non-GAAP metrics, off-balance sheet arrangements, or complex derivatives that no one fully understands but everyone wants to book as profit today. Because of Enron's ruthless games with hidden debt and self-dealing entities, regulators also keep reaching for its ghost. Enforcement actions still cite Enron-era schemes as the template. Opaque vehicles, circular trades, numbers that always go up until they suddenly don't. Policy debates over auditor independence, whistleblower protections, and executive certification still trace back to the wreckage that helped give birth to Sarbanes-Oxley. Whenever a new scandal breaks, whether in banking, crypto, or some shiny tech unicorn, commentators reach for the same comparison. It's an example of what happens when cleverness outruns conscience. Inside companies, the tension is constant. Shareholders want growth. Analysts demand a story. Bonuses hang on the next quarter's earnings. Leaders feel the pull to push the line, smooth the volatility, promise a future that may never quite arrive. Yet they also know that even the appearance of Enron-like behavior can vaporize a lifetime of work overnight. So they live in that narrow corridor between ambition and annihilation, trying to build wealth and power without waking the ghost that ruined so many careers, families, and retirements. His story is one of caution, at times inspiring, and at times chilling, because Enron's ghost only protects those willing to look it in the eye. As this story moves toward its end, the real question is not whether Enron still haunts the corporate world. It does. The question is whether leaders, investors, and viewers are willing to keep staring at that ruin long enough to recognize the next mirage before it collapses. So let me take you back to where this ghost was born, long before the headlines and the perp walks, when Enron was just a dull pipeline company in the 1980s, created by a merger that promised steady fees, regulated rates, and not much excitement. There was a time when its life looked destined to be boring, moving gas from point A to point B, collecting modest tolls, serving utilities, not history. Then ambition walked in the door. Jeff Skilling arrived with a trader's brain and a Wall Street imagination, and that sleepy pipeline operator tried to reinvent itself as a high-risk, high-reward empire of energy trading. Mark-to-market accounting turned long-term deals into instant profit, letting executives book tomorrow's dreams as today's wealth. Special purpose entities quietly carried away debt, hid bad bets, and paid handsome fees to insiders. On paper, money was everywhere. In reality, risk was everywhere. Culture followed the numbers. Skilling's rank and yank system, the cult of the smartest guys in the room, and a bonus machine wired entirely to short-term profits, created a life inside the company where fear and greed were not bugs, they were the operating system. Traders joked about Grandma Millie in California while manipulating power markets, shutting plants, and exploiting loopholes. The California energy crisis was not an accident. It was the logical extension of a ruthless mindset that treated human suffering as just another externality. From there, the unraveling was almost scripted. Sharon Watkins wrote her now famous memo warning that Enron could implode in a wave of accounting scandals. Skilling suddenly resigned, claiming burnout just as questions about the numbers intensified. Analysts who once worshipped the stock began to ask how a company with so much reported profit produced so little cash. Restatements followed, revealing that years of glowing earnings were built on sand and related party deals. Liquidity vanished in weeks. Creditors pulled back, rating agencies downgraded, trading partners demanded more collateral. Employees watched the stock collapse from over $90 to pennies, their retirement accounts locked while executives who had preached loyalty had already cashed out hundreds of millions. Careers evaporated, family plans disintegrated, and retirees who thought they had secured a comfortable old age woke up in a kind of financial poverty they never expected to see again. The blast radius did not stop at Enron's doors. Arthur Andersen, once one of the most respected accounting firms on earth, shredded documents, lost credibility, and then lost its life as a business. Sarbanes-Oxley rewired corporate governance, internal controls, and executive accountability. Trials sent Skilling and Fastow to prison and turned Ken Lay into a cautionary tale. His story is one of ambition, at times inspiring and at times chilling, but it is also an example of what happens when complexity, leverage, and short-term incentives outrun ethics and transparency. In that world, collapse is not a surprise, it is a scheduled event. And as the next section will show, Enron did not end this pattern. It merely gave it a name, a template, and a warning that markets still struggle to heed. There was a time when Enron's fall felt like a distant morality play, a story about greedy executives in a far-off glass tower. But this empire did not just swallow its own. It devoured the pensions, savings, and quiet hopes of ordinary families who thought they were being careful. The uncomfortable truth is that the next Enron does not need your permission. It only needs your inattention. So tonight, before the screen goes dark, the first step is simple. Audit your own exposure. Look at the retirement account with the friendly name, the 401k, the IRA, the pension statement that arrives once a year and goes straight into a drawer. How much of your life's work sits in one company, one sector, one story about endless growth? Enron's employees watched their wealth evaporate because their savings, their paychecks, and their loyalty were all tied to the same sinking ship. Diversifying is not exciting. It is the opposite of exciting. That is why it works. Then, for any company you work for or invest in, ask the questions almost no one asked about Enron until it was too late. How does this company really make money in plain language, without buzzwords or magic? Are the profits backed by actual cash in the bank, or do they appear only in earnings presentations and optimistic forecasts? When the business model sounds like a maze of derivatives, special entities, and clever tax structures, it might be efficient innovation, or it might be a smokescreen. It is an example of what happens when complexity becomes a weapon rather than a tool. Corporate governance may sound distant, but it is one of the few levers regular investors still hold. Those proxy ballots that arrive with tiny print and boring resolutions are quietly votes on how much power executives keep for themselves. Supporting proposals that demand clearer financial disclosure, limits on conflicted deals, and genuine independence on the board is not glamorous. Yet these small, untelevised decisions can slow the next wave of mark-to-market fantasies and off-balance sheet games before they grow into a $70 billion mirage. Beyond the market, this story is also about who shines a light when the room is full of money and pressure. Enron unraveled because a few analysts kept asking hard questions, a whistleblower refused to look away, and investigative journalists kept digging after the headlines moved on. Supporting real reporting, backing whistleblower protections, and refusing to mock the person who speaks up at the meeting are quiet acts of resistance in a culture that often rewards silence. Let me take you back to that final year before Enron collapsed, when the numbers still looked perfect and the bonuses still flowed. Almost everyone believed or pretended to believe because disbelief was expensive. His story is one of confidence, leverage, and illusion, at times inspiring and at times chilling, and the next version will rely on the same human weakness. The next Enron will count on the world not paying attention. The question is whether you will be one of the few who finally do. The $70 billion mirage is gone now. The stock certificates are framed on office walls as dark jokes. The pensions are scattered across bankruptcy filings, and yet the most important part of this story never showed up on any balance sheet. Trust. There was a time when Enron was sold as the future of American wealth and power. A company that could trade anything, anywhere, turning pipelines into a global empire of contracts, derivatives, and pure imagination. Wall Street cheered. Politicians smiled for the cameras. Families loaded retirement accounts with Enron stock, and the numbers kept rising. On paper. Until they didn't. Because of that trust, teachers, secretaries, and engineers watched life savings evaporate almost overnight, while executives who knew the truth had already cashed out. Because of that trust, a $70 billion valuation could float for years on mark-to-market fantasies, off-balance sheet debt, and a culture that rewarded whoever could tell the most exciting lie. It's an example of what happens when fiction is more profitable than fact, and when everyone who might say, "This looks wrong," decides to stay quiet instead. Underneath the spreadsheets, the story is simple. People believed. They believed the auditors, the analysts, the regulators, the charismatic CEO promising that Enron was ahead of the curve. Trust was manufactured in glossy annual reports, in magazine covers calling it most innovative, in bonuses that said, "You're winning, don't ask how." Then, in a few brutal weeks, that trust vanished, and the cost was measured in ruined retirements, lost jobs, and a public that learned to doubt everything. Ambition and innovation did not cause this on their own. Those forces built railroads, satellites, and fortunes out of poverty. The danger came when ambition met weak guardrails, when innovation became a shield for secrecy, when creative accounting turned into a weapon. The same drive that can create extraordinary value can rationalize extraordinary harm, once the only scoreboard that matters is the stock price at 4 p.m. Here is the uncomfortable part. This is not just their story. it is also yours. Every time a person puts a paycheck into a 401k, joins a company because everyone says it's a rocket ship, or scrolls past financial headlines without reading the fine print, choices are being made. Choosing where to work, what to invest in, and what questions to ask is not a spectator sport. Indifference is a vote too. Pattern interrupt. Imagine the next Enron doesn't look like an energy trader at all. Imagine it is a social media giant, a crypto exchange, a green company promising to save the planet while hiding its own numbers in the shadows. The labels change, the incentives do not. The forces that built Enron have not disappeared. They have better software, faster markets, more complex products, and a deeper understanding of how to sell a dream. They are waiting for the next moment when no one is watching closely, when trust is cheap and questions are expensive. The story of Enron still matters because somewhere, quietly, the next version is already being written, and whether it ends the same way will depend, at least a little, on whether you finally decide to read the fine print. So here is where this story stops being about Enron and quietly becomes about you. There was a time when people in Houston, in New York, in tiny towns across America, felt absolutely certain their company was solid, their retirement was safe, their leaders were brilliant. They had the headlines, the glossy annual reports, the soaring stock price. What they did not have was the habit of looking underneath. So one concrete move, not someday, not when the market feels calmer. Within the next 24 hours, pick one thing from this story and actually do it. Open the 401k statement that has been sitting in the drawer and ask how much of your life is tied to a single company. Pull up a company's 10K, scroll past the shiny letter to shareholders, and read the footnotes on debt and special entities. Look up the board of directors for the place that pays your salary and see whether it is a real check on power or just a polite dinner club. Because Enron's life shows what happens when everyone assumes someone else is watching. Analysts trusted the auditors trusted the executives, employees trusted the stock, and regulators trusted the headlines. It was efficient, it was comfortable, and it was, at times, inspiring and at times chilling, a perfect environment for a $70 billion illusion. The numbers were there the whole time. Almost no one chose to read what they were really saying. In the comments, leave a record of how this hit you. Which part of Enron's empire shocked you most? The mark-to-market profits booked on day one, the maze of entities run by the same CFO, or the way employees were locked into Enron stock while executives quietly cashed out? And more importantly, what are you going to change about how you judge a company's wealth, risk, and leadership the next time a can't-miss story crosses your screen? If this deep dive helped make a little more sense of how money, power, and clever language can collide, do not let it be the last time. This channel is here to keep walking through the hidden architecture of markets, the fine print of corporate power, the moments when an empire looks invincible right before it cracks. Subscribe because Enron is not an isolated scandal. It is an example of what happens when the same pressures are allowed to run wild, again and again. And when this ends, do not just click away. Let me take you back to 2008, or to the next great corporate fall from grace, in the video waiting on your screen right now. Different names, different products, the same patterns wearing a new disguise. Because in every age, the numbers will always tell a story. The question is whether you are willing to read past the headline